What do we want to see? We want to see more good data. I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting.
I think that's the story. Is it May? Is it June? It's not March. It's pushing back because they don't want to rush into a cutting cycle.
If the economy wasn't as strong as it was, the Fed would be much more inclined to cut rates.
Markets really want to take off and put a lot more cuts in than the Fed is really willing to do.
Jay Powell thinks the runway for a soft landing's in sight, but right now that's a forecast.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
It's like we never left. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance alongside Lisa Abramowicz together with Annmarie Hordern. I'm Jonathan Ferro. Your equity market on the S&P 500 bouncing back from the biggest one-day loss since September. Equity futures on the S&P 500 positive here by 1/3%. Bramo, pushback from Chairman Powell. Big earnings coming a little bit later.
Yeah, basically taking March off the table maybe, or making it less likely. The market's responding to that. Big tech very much front and focus. And the real question to me is, do we get a more motley picture with the likes of Meta, with the likes of Apple and Amazon reporting after the bell than we did with Microsoft and Google, which put out solid earnings, but people just weren't impressed?
Before we talk about tech, we need to talk about the financials. We seem to be at the phase of the cycle where we talk about banks we've never heard of before. One in Japan, another in New York. Commercial real estate is something that's been hanging over this market for a long, long time. Are we starting to see a little bit of a reality check on that side of things?
So the reality versus the fiction. The fiction that some people might say is this another crisis in the making in regional banks? And most people say no. New York Community Bank Corp was an idiosyncratic story with respect to the mix of holdings. That said, you have serious concerns about a reckoning that has not happened in commercial real estate. And those were just exacerbated with the Azora Bank in Japan reporting a 20% drop. You're seeing a 20% drop in their shares as a result of U.S. property losses. So again, it's the shoe that hasn't dropped in commercial property, not necessarily fears of a banking collapse.
This is your world, so let's talk about it. These things have not been marked to market. A lot of these banks thought they could hold them to maturity and hope that things would get better. That maturity wall seems to be on the horizon now, end of 24, start of 25. And you just wonder how much more of this we see. Banks coming out and saying, you know what, provisions, they need to go up.
Especially because a lot of these banks have sort of floated below the radar of having to report and sort of meet certain regulatory hurdles. If they increase the regulatory hurdles, you could see a reckoning that's more significant. Barry Sternlicht recently, this week, said that he expects about $1 trillion of losses in the office space asset class. How much of that are we going to see in the bank balance sheets, especially given how much they really have lent in this case?
These are the scars of the pandemic when it comes to real estate and commercial real estate. And he said there's $1.2 trillion of losses spread somewhere. Nobody knows where they are. So when does this come home to roost?
We've got a decent idea of where they are. Smaller banks, not larger banks. JP Morgan had the numbers on that. I think if you look at the amount of loans here, Lisa, commercial real estate loans account for 28.7% of assets at small banks, according to JP Morgan, compared with just 6.5% at bigger lenders. Once again, it seems to be a series of events where we sit here and say the problem is not in the larger banks, it's in the smaller ones.
And it just hasn't been revealed yet. And that's the reason why we saw the KBW Regional Bank Index have its biggest daily sell-off yesterday since what we saw with Silicon Valley Bank. Key question to me is, does this rise to the threshold of mattering to the Fed? Turns out yesterday, no one asked, but it seems like everyone we talked to said no. But to me, I mean, it didn't seem like it factored into their calculus. So if this isn't a systemic issue, you're not going to get sort of the relief valve, at least from that vantage point.
You almost framed that perfectly. What we should have said, did it rise to the threshold of people in the news conference caring about it? Apparently it didn't.
Said. Yeah, exactly.
I need to talk to Mike McKee about that. Why on earth nobody asked about the situation in the banking system just yesterday?
Well, in defense of the journalists, given that this was an evolving story, it broke just before Jay Powell came out, he likely would have just brushed it off and said, I don't have enough information yet to comment on it. And then you've wasted your question.
The rules of surveillance don't defend journalists, OK? Equity futures on the S&P 500 positive here by 0.4%. The S&P a little bit higher, bouncing back. Yields higher too, up 3 basis points, 394.43. Bramo on a 10-year, I think that was the first close below 4% on a 10-year in more than 2 weeks.
And it came despite the fact that people were repricing the likelihood of a March rate cut. But if you take a look, they're pushing them out. It seems like the Fed is very much in a posture to cut rates and is really trying to embrace this immaculate disinflation. So it seems like the bond market's cooperating.
Coming up on the programme this hour, we'll talk about that with Marvin Lowe of State Street as the Fed appears to dash hopes for a March cut. Bloomberg's Alex Webb with Amazon, Meta and Apple set to report after the close. And Jennifer McKeown, former Bank of England economist, counting us down to the rate decision from the Bank of England in just about an hour. We begin with our top story. Fed Chair Jay Powell pushing back on a March rate cut. We're not declaring victory at all. I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting. Marvin Lowe of State Street, not surprised, writing, quote, strong consumption growth and a still relatively robust jobs environment would push back against the view that we are really in restrictive territory. Marvin Lowe joins us around a table. Morning, Marvin.
Morning, thank you.
What did you make of that performance yesterday in the news conference?
You know, it was interesting, for sure. I think there's been more discussion about this presser than we've had in a while, where everything kind of, if you will, packaged around. I think it was a fairly positive view ultimately for the economy. The market got ahead of itself. You know, we had been saying that March really didn't make sense. The data was strong. Consumption was certainly out there from a perspective of really continuing to support kind of a slower inflation down ramp. But we heard from the chair that all inflation needs to do is do what it's been doing, and they're going to start cutting. And, you know, I view that as pretty positive for the markets ultimately.
Straight to the statement, the committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably towards 2%. So everyone wants to know that we asked about 20 different ways in the news conference yesterday.
For sure.
How do you get greater confidence? What does that mean?
You know what? It really sounded to me as if Chair Powell was ready to cut. You know, he really liked the data. He, you know, highlighted that ultimately we need to just continue to see what we saw. I think a lot of this is hurting the FOMC cats. I think you mentioned it yesterday, Lisa, later in the afternoon. I think the cats are ornery and they're kind of running around, and it's a matter of time. You know, this data is going to continue moving towards that target, particularly, you know, the PCE discussion that we've been having over the last couple of weeks.
The cats are ornery, and that's the reason why you got a really sort of muddled response. It was the data is good, the data is going to happen, and then we're going to respond to it. That was his explanation of what he's looking for. I am curious about kind of what the parameters are, right? What the hesitation is. If you think that the market now is pricing in the right chance of a March rate cut at 37%.
Yeah, so a couple interesting things. One was, for the first time, he said that they're looking at inflation from an aggregate perspective. So kind of that pushback that, you know, services inflation has to get to a certain point, housing inflation has to get to a certain point. I think that that's where the holdup is for, you know, the ornery cats, if you will. But if inflation moves in the right direction, they'll be able to start normalizing. And, you know, remember, we're talking about normalization. We're talking about a Fed that thinks that there's several hundred basis points in restrictive territory. They could start the process and really see how those more sticky types of components move and whether or not we get to maybe some of the more aggressive market pricing.
If you channel an ornery cat and you think about what happened with New York Community Bank, and you think about what happened with potential losses that have not yet been revealed, does that on the margins make you more likely to move into an easing posture?
If it develops to something greater than what we saw yesterday, yes. I would add that nobody asked about that bank, and the Fed actually took out the section that they previously highlighted, which was very much bank related. So it's not an issue for them. And I think, you know, commercial real estate certainly is this brewing problem that we all know about. Banks are regulated. It's nothing new, ultimately, unfortunately. And it's not going to become systemic. So, you know, if it balloons and there are pockets within portfolios that surprise us, for sure. But, you know, I'm operating that we've known that there's a commercial real estate problem now for several years.
So, Marvin, I think you've touched on the right word. There is systemic risk, and then there is just a massive headwind to profitability for an industry group.
Yes, yes.
Where are the financials now going through the rest of this year, given the fact we've got a deal potentially with some big unrealized losses in commercial real estate?
Yeah, you know, working for a bank, there's always things that are thrown at us ultimately. It's a challenge. We are, you know, when you're investing in a bank, you're investing in that management team, you're investing on how they approach their loans, and ultimately how the market views the viability of that bank from a deposit perspective. And that doesn't change. So it does come down to that individual bank analysis.
Does it lead to tightening lending standards, though? For someone who's looking at the broader economy at the moment, is that something you should be concerned about? That ultimately, they're going to have to hit the brakes on the economy?
Sure. Yeah, for sure. And that is part of the tightening process. It's not necessarily wrong to expect this late in the cycle to have more tightening than we've seen.
That's the reason why it sort of begs the question, are people pricing in too much perfection?
Yes.
Okay,
yes.
So then where exactly, especially given the fact that it really has been led by the Magnificent Seven, or what Mike Wilson thinks should be the Magnificent Four. But I am curious about whether you see sort of a risk-off kind of tone, especially given some of the consensus that we've been hearing, everyone kind of being bulled up.
Yeah, I mean, I think the everything up rally is done. I think we need to parse through and really figure out what parts of the story we want and we want to hedge. There's a reason that U.S. tech is where it is. I still like the earnings power, and as a little bit more of a longer-term investor rather than kind of a trader, if you will. It's undeniable that they have this moat that is the envy to any other company in the world. The U.S. exceptionalism is a story that's really starting to come out. What the Fed is focused on versus what the ECB, what the BOE, and a lot of the other central banks are worried about is very, very different. And then, I think that there is tail risk from both inflation not necessarily packaging as well as the market is saying. You can hedge that. Energy is a hedge if you wanted to approach it from an equity perspective. And then recessionary-wise, there are certain markets in the world that have more value, if you will. The UK comes to mind from the perspective of a very staples-driven value kind of market.
Wait, just before we let you go, UK being a bright spot, haven't heard that in a while, especially given the fact that they just saw inflation go up for the first time in 10 months, CPI, and they have a weaker growth outlook than the vast majority of G7 nations. Why is it appealing to you?
You know what? I wouldn't say it's a bright spot. What I would say is that it provides a hedge for those that are worried with a larger global downturn in growth. Their markets would be more supported in that kind of environment.
Marvin, you're going to stick with us, I'm pleased to say. Marvin Lowe there of State Street. Equity futures on the S&P positive here by 1/3 of 1%. Lisa, I was just going through the numbers. Apple, Amazon, Meta, 12% of the S&P 500 across 3 names.
It's ridiculous. I mean, we saw 11% report on Tuesday, which is the reason why everyone cares about this so much. Key question again, how high is the bar? And to me, the Apple, Amazon, Meta story is much more interesting than the behemoths of Microsoft and Google that sort of are winning the AI game.
Those earnings coming up a little bit later on this afternoon. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. EU leaders have struck a deal to send 50 billion euros in financial aid to Ukraine. The agreement happening after Hungarian Prime Minister Viktor Orban lifted his veto on the package. Under the deal, EU member states agreed to debate the implementation of the aid package every year. The breakthrough avoids a contentious split with the EU and marks a significant boost for Ukrainian President Volodymyr Zelensky. Top Silicon Valley executives were grilled on Capitol Hill over online child safety. Ranking member Senator Lindsey Graham says the social media giants must be reined in.
Mr. Zuckerberg, you and the companies before us, I know you don't mean it to be so, but you have blood on your hands. You have a product. You have a product that's killing people.
The Senate Judiciary Committee wants Meta, X, TikTok, Snap, and Discord CEOs to endorse proposed bills for stronger protections for children using the apps. 7-time Formula One champion Lewis Hamilton is on the verge of a shock move to Ferrari for the 2025 season, according to reports. Hamilton recently signed a new contract at Mercedes, but is able to leave at the end of the season. Ferrari wants to pair him with Charles Leclerc next year. And that's your Bloomberg Brief. John?
Yahara, thank you. It's emotional. I've got no one to share this with.
I was going to say, who are you going to share this with?
Absolutely no one to share this with. So I share it with you at home. It's the marriage, the partnership we've always wanted. I think we've always felt like Lewis Hamilton has wanted this as well. And I just think it's beautiful. It may happen in 2025. And I'll be there, September, Monza, Italy, 2025, just to see that happen.
Just so you know.
Just to connect with the audience. No one around the table wanted to connect with me on that story.
I'm interested in this trip to Italy, but...
You want to come on board for that? Up next on the programme, a border deal hitting a wall in Congress.
This is not conjecture. It's not Republican talking points. This is what the experts at the border, at the epicenter, tell us is necessary and needed.
That's coming up next, live from New York City this morning. Good morning. You're watching Bloomberg TV. Live from New York City, here's your equity market bouncing back by a third of 1% on the S&P 500 following the biggest one-day loss going back to September on the S&P. Under surveillance this morning, a border deal hitting a wall in Congress.
House Republicans are not here to supply more buckets. We are here to stop the flow. And stopping the flow is not rocket science. It takes political courage. It takes transformational policy changes, and we know what policy changes will accomplish that. This is not conjecture. It's not Republican talking points. This is what the experts at the border, at the epicenter, tell us is necessary and needed.
Here's the latest this morning. House Speaker Mike Johnson casting doubt on a deal to secure the southern border, leaving the fate of the Senate's bipartisan bill in question. The latest Bloomberg News Morning Consult poll showing voter concerns about immigration gaining ground on the economy is the top issue. 6 in 10 swing state voters say President Joe Biden bears responsibility for a surge in migrants at the US-Mexico border. Ed Mills, a Washington policy analyst at Raymond James, joins us now for more. Ed, let's talk about the deal we can't get done, and then we'll talk about a deal in the House we just got done. How difficult will it be to find agreement on addressing the southern border?
Well, the Senate's going to move first here, and we're going to see if the Senate can actually get legislation released, working on that. But if the Senate were to pass a border deal and the Speaker were to bring it up in the House, he'd be former Speaker Johnson. There's no political desire among a core group of House Republicans to get this done. There's a core desire among a core group of Senate Republicans to probably not get this done. So we do look at this very much through the political lens. You highlighted kind of the impact on the presidential elections. When we look at polls, when we talk to pollsters, the border, inflation, geopolitical risk are some of the biggest drags on President Biden getting reelected. And so for Republicans, they're not very interested of handing kind of a win to President Biden because they clearly have an alternative candidate in Donald Trump.
Well, Ed, let's talk about the bill that did get done overnight. Except Senator Chuck Grassley in the Senate saying the quiet part out loud when it comes to what the upper chamber may do. Passing a tax bill that makes the president look good, mailing out checks before the election means he could be reelected, and then we won't extend the 2017 tax cuts. Do you expect this tax bill that passed on a massive bipartisan support overnight to actually get passed in the Senate?
I think it has real momentum, Annmarie. I don't think that this is a kind of guarantee. But when you look at this bill, it has a couple of provisions that are really important. First of all, it always gets this headline that it's $78 billion. It's actually much more than that. For 2024 tax returns, it's $125 billion benefit for research and development, bonus appreciations for corporations. It's $8.3 billion in expansion of the child tax credit. Also in the bill is tax relief for those who got disaster aid in 45 states. And so the momentum has built on this bill. It's not yet kind of clear exactly the timing in the Senate, but I think it has a greater than 50% chance because with that momentum and that 357 to 70 vote, it's hard to be that individual in the Senate who's opposed to this, especially as there's so much pressure to get this across the finish line. But as you mentioned, we are in an election year, and politics absolutely will play a role in kind of how fast and if this gets done.
And the White House already has come out and said they want to sign this bill into law. But what kind of amendments could we see from the Senate side?
So I don't think there's much time for amendments in the Senate side. What we are hearing in terms of conversation is a desire to maybe expand out the state and local tax deduction. There's going to be a vote potentially in the House on that sooner rather than later, expanding it from a $10,000 maximum deduction to $20,000 for individuals that in households below $500,000 of income. That's going to get headlines. That's not going anywhere. In the Senate, they've talked about some of the provisions of the child tax credit being too expansive, the fact that you can choose 2 different calendar years for getting the benefits. So right now, I think if there is real opposition, this dies because remember, the tax filing season started on Monday. We're in overtime and we're trying to change tax policy for last year. Well, the tax filings are already underway. There's not much time to get anything changed.
Ed, I was really struck by all the articles and research that I read about this, about the dissent from the Freedom Caucus. And I keep wondering, given that sort of tension, why Mike Johnson isn't going to go the same way that Kevin McCarthy did.
It's a great question, Lisa. But, this is something that passed with 357 votes. I mean, it's unusual to have something that this is bipartisan. Yes, there was a core group of House Freedom Caucus members who were opposed to it. There was a small group of members from high tax states, the SALT caucus, that were opposed to this. But what Speaker Johnson said is if there's a bill that has overwhelming support, he's going to put it on the floor. He's not going to kind of fall on his sword for this. He will fall on his sword or kind of make sure that the politics of the border bill are done. But this is something that has momentum. And what I've been telling investors kind of to take a step back is that there was a real concern when Republicans got a majority that we could see a fiscal drag and real budget cuts. And when we look at what we're going to do on appropriations over the next month, if we get a defense supplemental, we could pull that out of this border versus defense deal. If we get this tax benefit, the spigot's still on. And that adds to the conversations of whether or not we're going to have a soft landing, because a lot of support is out there, especially for the households that are at the lowest income level, that has the biggest concern of dwindling savings. Bills like these actually help quite a bit.
I guess to put a bow on it, is it that Mike Johnson has sort of more cohesion among his party, especially with a presumed nominee for the presidential election of Donald Trump? Or is it just that people are getting too tired to keep fighting and keep just throwing out their House Speaker?
Lisa, I think it's more of the latter. He has done things that have disappointed individuals, but he hasn't crossed kind of that threshold. And the fact that we went through kind of so many rounds before we chose a new speaker here in D.C., and there's no heir apparent after that. The opposition probably comes maybe from some more of the moderates, and there's just not a real desire to show a lot of dysfunction among House Republicans any more than it's already occurred, because they think that would hurt them come November in keeping the House. So, it's nice when you don't have someone who is going to be easily replacing you when you're in a position like Speaker Johnson.
Ed, good to catch up. Thank you, sir. Ed Mills there of Raymond James. Thank you. Marvin Lowe of State Street still with us around the table. Marvin, here's a tough one for you. Can you have an outlook for 2025 without knowing who's going to win the election this year?
It's tough. It certainly is tough. The Trump policies would be such a departure from kind of where we are now that it is very, very hard. I think you're starting to see some of those bets being made. Each one of these polls, as we kind of move to a national stage rather than kind of looking at the regional primaries, even though we've still got a lot left, is starting to make its way into customer conversations for us, at least.
Don't you think these conversations are happening at the Fed? If you look at 2025, politics affects policy, which affects the economy. Don't they have to start caring about who's going to be in the White House?
You know what? They shouldn't. So, the Fed obviously is supposed to be apolitical, but from a deficit perspective and really worrying about the Treasury market, I do think that those conversations are out there. And I think part of the Fed certainly doesn't want to be at the helm of a recession. But part of really this pivot discussion over the course of the last couple of quarters, to me, is to avoid a recession, just because the amount of debt that would come about from stabilizers around that. I think that's part of the calculus for them.
You said two things. One, that bets were starting to be taken, and two, it was coming up in customer conversations. How are they expressing this in markets right now?
Yeah, certainly folks are starting to really think about how trade might get affected. That wound up being clearly one of the more changes under the last Trump administration. Mexico and whether or not it winds up being at the eye of the storm the way they were last time is certainly conversations around that. And then really over the overall plan to tax everything and whether or not there's an inflation component associated with that. Because the last time we tried to tax everything, inflation actually went up. So, there's hedges around that. I think those are our conversations these days.
Interesting. Marvin Lowe, State Street. Marvin, great to catch up.
Thank you.
Lisa, I imagine we'll have more of those conversations in the weeks and months to come.
Especially because the two policies aren't as different as some people might
suggest.
It's true, too. Yeah, so it's sort of, either way.
Coming up shortly, counting you down to earnings from Apple, Amazon, Meta after the close. Live from New York City. You're watching Bloomberg TV. Yesterday was pretty interesting, let's put it that way. In the equity market, bit of a downdraft, biggest one-day loss on the S&P 500 since September. I think of the Nasdaq, biggest one-day loss since October. State of play this morning, bit of a bounce, positive a third of 1% on the S&P. On the Nasdaq, up a half of 1%. In the bond market, interesting morning going into the afternoon. Had some ECI data, small downside surprise, and then the big thing kicked off. Started to worry about banks all over again, yields aggressively lower, then lower again in the news conference, and then we finished lower, I think, by about double digits, basis points, 2-year, over to the 10-year, Lisa.
Basically, people looking at the fact that the Fed is probably less likely to cut in March, but still on an easing path this year at a time where we're clearly seeing the stresses coming up still from the commercial real estate problems that people have been talking about for years. Still, though, the unknown is looming, and the unknown being reported as potentially more than expected is spooking some.
So Chairman Powell was not a snooze. The ECB last week was. The euro looks like this, 108.04, negative by 0.1%. I have to say, just to sit on the story just for a moment, that is a big aid deal that's come out of Europe today, Annmarie, for Ukraine. And the difference between Europe and the United States is pretty stark once again.
Yeah, 50 billion euros. Ukraine desperately needs this. We've heard from President Volodymyr Zelensky talking about the fact that they really need some of this aid, and they're suffering on the front lines because of it. Interesting, they were able to get Hungary's Viktor Orban on board, Jonathan, to get this deal across the finish line.
What's amazing, though, that number. Can you imagine if the Europeans had invested that number themselves in defence over the last 5 to 10 years?
Well, this was the complaint you heard from the former President Donald Trump that we then spoke to Mark Rutte, all three of us, at Davos about, and he said this was appropriate in terms of a criticism for Europe. We should have been investing in our 2% defense, and now they're going to have to start. You saw a complete 180 from the German Defense Ministry when you saw Russia's invasion of Ukraine.
That's a big change. 108.05 on the euro against the dollar. Under surveillance this morning, Fed Chair Jay Powell dashing hopes for a March rate cut. Speaking after the decision to hold rates, Powell saying, quote, "We're not declaring victory at all. I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting. Market odds for cuts in March have fallen from over 50% to just over 1 in 3. Lisa, I think we should leave the quote up because he doesn't say no. He says it's just not likely. And I think the economic data between now and then can always change that conversation and change it fast.
Which maybe makes tomorrow's jobs number really live, right? We might actually get
in some ways,
significant.
sure.
Yeah, I mean, if it's a real downside surprise, suddenly March could be back on the table. The bigger takeaway is they're ready to ease. They're happy with what they see. They just want to keep seeing more of it. So now how do we price in exactly how much they're going to cut? To me, this sort of puts the Fed on the back burner in my mind and puts earnings very much in the front and center.
Yeah, I think you're right. And also I'd say this. I think the earnings and the data specifically, I think the Fed views this quite asymmetrically now. Good data is not a problem.
Yes.
I've been pretty clear about that. If you told me 12 months ago is good data a problem, I would have said yes. The Fed chair told you yesterday it's not. And we now know that if the data gets weaker, they're willing to step up more quickly.
It's a great point. They are not scared of strength. They want to see strength. He even said that explicitly. This idea that you can get strength and have your cake too in the terms of disinflation is something that's new.
Let's talk about where there is no strength right now. Worrying signs in the banking sector and commercial real estate. New York Community Bank Corp plunging as much as 46% yesterday after the bank's loan loss provision surged to $552 million. The bank took on part of Signature Bank last year during the crisis in regional banking, including a pair of troubled loans for a co-op complex and office space. One bank in Japan also sinking, warning of a $191 million loss tied to commercial real estate in the United States. I said at the top of the programme, we're at that phase of the cycle where you talk about banks you've never heard of before. I've never even read that name out.
I know, which is the reason why I didn't read it, and I'm laughing.
Lisa, this is where we're at now, easily spooked about something we've been talking about for a while.
It's the idea of losses being bigger than we previously expected, and I think it's Aozora, probably, in Japan.
Nailed
That's how
it.
I pronounce it. But honestly, I'm looking at this. It's the idea of bigger losses than expected. We've known this is a problem. Have we been accurately pricing it? Not necessarily a systemic issue. It's this question of have we adequately accounted for weakness in sectors like the office space sector that are just existentially challenged, according to some.
We're speaking to Chris Marinac of Jenny Montgomery Scott on the regionals and at smaller banks. I'm looking forward to that conversation, I think, in the next couple of hours. Lisa, I'm going to use a word, not my word, a word that will be used around New York Community Bank Corp. Idiosyncratic. How idiosyncratic is New York real estate, given the change in regulations over the last couple of years?
A lot of people would say that it's idiosyncratic in terms of the depth of pain, the depth of loss, particularly in office properties, and the sort of bifurcation between office property that's used and that's definitely invested in and expensive, and those that are just being left for dead. That said, it's not that idiosyncratic in terms of office space and other types of sort of reckoning that have not yet been fully priced.
Certainly wasn't taken that way yesterday, given the move we saw in the regional bank index from KBW. You said it earlier, I think down something like 6%. Worst day going back to spring of last year. Deutsche Bank with some news this morning, slashing 3,500 jobs. In earnings this morning, the bank also raising its revenue target with a plan to buy back 675 million euros worth of shares. Deutsche Bank outperforming peers. BNP Paribas messy, according to one analyst. ING sliding after missing estimates and lowering expectations. Deutsche Bank this morning, Bramo up 5%. Look at the different story over at BNP. We're down 7 there. ING also down almost 8%.
And Deutsche Bank has said that they're going to actually make additional cuts after already cutting pretty aggressively and seeing their expenses come down. What I think is interesting about BNP and ING is that everyone's been saying, OK, it's finally the time for European banks. I want to get some of those people back on and say, OK, is it really still? I mean, are you reassessing how much this is really going to fuel earnings in a new way for the banking sector in Europe?
The latest on Deutsche Bank, BNP and ING this morning. Big tech earnings coming after the market close. Apple, Amazon, Meta, all coming off a strong year of gains. Apple looking to avoid a 5th straight sales decline, which is amazing when you look at the share move of Apple over the last year. Investors looking to Amazon and Meta for progress in artificial intelligence while avoiding disappointments like Alphabet and Microsoft earlier this week. Bloomberg's Alex Webb joins us now for more. Alex, let's start with Apple and just think about the move we've had over the last 12 months. Fantastic rally. And the fact we're discussing whether they can avoid another sales decline. How do we reconcile those two things?
Well, they still post remarkably good EPS growth, right? The market's looking for a 12% bump in EPS, earnings per share, in the most recent quarter. They find a way, even as the top line numbers slow, of leaning more into the high margin products. So if you're selling the iPhone you want to be selling is stuff with a lot of memory, because the margin on memory, really, really good. If you're experiencing growth in your services business, that's things like the App Store, where it's basically software and very high margin, things like iCloud, all those sort of things. They've really managed to squeeze the profit out of sort of every last dollar. And, it's very much Tim Cook's Apple.
At this point, is the bar fairly low for Apple, given all the bad news that's been coming out? Is it lower than, say, from Microsoft and a Google?
It's certainly not been trading anywhere near the multiples of Microsoft, which is at something like 36 times its forward earnings. Apple's more in the sort of mid-20s at the moment. So with that being the case, quite possibly. But it's still, again, one of these magnificent seven, has enjoyed a pretty good year, as John was saying. I think, though, people are aware of there being quite a lot of headwinds. I think it's been quite well telegraphed that there are problems in China. The really interesting thing will be seeing quite how bad those problems are. There was some reporting from an analyst last week that suggests they could experience a 30 to 40% sales decline in China in this calendar year, or in this financial year as well. If there's any indication of it being even worse than that, then you start to have a bit of a problem.
The reason why I ask is because I wonder if the bar is somewhat higher for Amazon and the potential to disappoint is that much greater. And I ask this because AWS has a real question mark around it, the cloud services business that has driven so much of the profitability. How much market share are they going to be losing to Microsoft, to even Google, because of not as robust of an artificial intelligence offering?
Yeah, I think it is a thing that a lot of Amazon investors are looking at. As we know, even as the e-commerce business accounts for a huge amount of the lion's share of the revenue, almost all the profit is generated by AWS, at least in the current way it's set up. And the thing that's interesting is if you look at Microsoft's numbers from the other day, if you strip out what it attributed to the AI gains of about 6 percentage points, actually the growth of its cloud business wasn't terribly impressive. That was one of the reasons, actually, that the share price got a little bit punished by investors in the hours and days afterwards. Now, is that because in general the cloud market is not good, or is it because Amazon is actually succeeding in gaining share in that core cloud business? Yes, the AI stuff is important and is going to get more important, but for right now, it isn't something where companies are changing their whole business just yet. That might be yet to come, in which case people want to know what Amazon's plan is. But is the core business actually still showing some resilience without that AI consideration?
Alex, I wanted to ask you about the Vision Pro headsets, because they go on sale tomorrow in the store, even though they seem to have sold out in pre-sale. Is Apple banking on this future?
No, I think one of the things, and I wrote this in a newsletter last week, one of the things that's sort of misunderstood about the Vision Pro, to my mind anyway, is that Apple does not need it to be a success. There's an important caveat to that. It doesn't need to be a success as long as no other headset is a success, right? Because it can't afford for the next sort of vector of computing, personal computing, to be, on your face in terms of smart glasses or something like that, and it not to have a product there. Now, if the space doesn't take off at all, Apple's fine. It's still pretty dominant in mobile phones. It's, as of last year, the biggest seller of mobile phones and the smartphones in the world. It's got a very strong position in of course, PCs or laptops, computers, and in tablets. So it'd be, if it gets a bit of a boost from this in the medium term, it won't complain. But it's less important than ensuring that Meta doesn't dominate the space in the years ahead.
Alex, that's product. Let's talk about geographies. China. What's the latest on that? You and I have been talking about this all of last year into a new year about the clampdown on foreign tech and all of that coming out of China. How have things changed?
Well, the thing that's been sort of cracked down on is very much the government, in government departments, in state-owned enterprises. The message has gone out, according to Bloomberg reporting at the very least, that you should not be owning Apple devices. The question, now that in and of itself isn't particularly bad news for Apple. It's probably a bit of a rounding error when it comes to the actual unit sales. It's more the kind of mood music, what this means actually for the perception of Apple in the country as a whole. We saw this 6 years ago where there was a sort of real upswell in patriotism where people said, oh, we need to buy Chinese. If that is happening right now, that is clearly bad news for Apple. The Min-Ching Kuo report from last week that I mentioned earlier, talking about the potential for a 30 to 40% sales drop in China, that would be clearly quite painful, particularly as China has been, up to this, the recent quarters, actually a bit of a bright spot. Having recovered from that slowdown of sales a few years ago, it was experiencing growth again there, and that's not something you could say about it globally. So it is a concern for Apple. But again, as I said at the very beginning, it still somehow manages to find a way of eking more profit out of the dollars that it does sell in revenue.
Given the mood music regarding relationship between Washington and Beijing, is this only going to get worse for Apple to try to continue gaining market share in China?
Certainly right now, it doesn't look like it's going to get any easier. I think the other concern, of course, is what it means for Apple's manufacturing base there, right? It employs directly and through its contract manufacturers, millions of people there. China probably doesn't want to be losing those jobs. At the same time, Apple has been gently trying to increase manufacturing capacity in geographies like India, Vietnam, and elsewhere. So at the moment, they are still very, very small and it's very, very nascent. But any constraints on Apple's ability to build, cutting-edge devices, what it sees as its cutting-edge devices in China, is the other side of the coin that they really don't want to put at risk.
Hey, Alex, great to catch up. Alex Webb there of Bloomberg on the latest. More earnings coming this afternoon. Apple, Meta, Amazon. Some earnings coming right now from a cruise liner that was up 162% last year. Lisa, one of the best performing stocks on the S&P 500 in 2023.
Cruises are hot. I mean, I think that you
Apparently,
should take one. Yeah. Essentially, Royal Caribbean coming out. Adjusted EPS for this year is seeing $9.50 to $9.70 versus the estimate of $9.15, seeing first quarter adjusted earnings per share of $1.10 to $1.20 versus an estimate of 91 cents. Shares are climbing more. People are going on cruises. It's the post-pandemic reality, John. When are you going to go?
Have you seen the Icon of the Seas? Have you seen this ship?
No, I haven't.
7,500 passengers, 20-deck ship. It looks like a theme park on a boat.
That's what they are.
It looks absolutely ridiculous. Well, you should Google this boat.
Okay,
it's absolute nonsense how big this thing is.
Nonsense for one person and just absolutely a wonderful way to vacation with family for another person. I'm just throwing that out there.
Especially if you don't like to fly. My father hates flying, so a few times we were forced to go on cruises.
What was your experience of it?
It was nice. But we went on smaller ones,
smaller boats.
Not these massive. I'm looking at this Icon of the Seas. It looks like Disney World's on a Disney World.
Thank you. That looks like a nightmare to me. Stuck with 7,000.
No, but you are very particular in your cruise.
Absolutely not. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Boeing CEO Dave Calhoun has admitted the company, quote, caused the problem behind the incident that saw a door plug blow out during an Alaska Airlines flight last month. Speaking on the company's earnings call, Calhoun said an investigation into the cause is underway, but the ultimate responsibility, he said, is on Boeing. The plane manufacturer declined to issue a financial forecast for the year. Workers in transportation and warehousing took home record pay in the last quarter, according to new data from the Bureau of Labor Statistics. Employment costs in transportation jumped a record 6.3% in the fourth quarter from a year earlier. Meanwhile, factory workers fell behind. Their pay climbed just 3.7%, and the biggest gap between the two sectors on record. And Elon Musk is going all in on Texas, seeking shareholder approval to move Tesla's corporate registration from Delaware to the Lone Star State. Musk took to social media platform X to poll users on the change before saying Tesla would soon hold a shareholder vote. It came after a Delaware court voided the CEO's $55 billion pay package, calling it excessive. He's already moved Tesla's home office to Austin and relocated himself and his charity to the state. And that's your Bloomberg Brief. John?
Yahira, thank you. You should see Lisa's face. Googling this. Looks absolutely disgusted by it. 1,200 feet long, almost 4 city blocks long.
It looks like being trapped in a Las Vegas casino.
46-foot tall drop slide. That looks fun.
Okay, for a day, maybe.
See?
That's the issue.
Okay. Up next on this program, the Fed in no rush to cut. The BOE
I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting to identify March as the time to do that. But that's to be seen.
That's next. You're watching Bloomberg Surveillance live from New York. This is Bloomberg. Live from New York City this Thursday morning. Good morning to you. Equity futures bouncing back from yesterday's losses on the S&P 500 at 1/3%. Under surveillance this morning, the Fed in no rush to cut. The BOE on deck.
I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting to identify March as the time to do that. But that's to be seen. So I wouldn't call, when you ask me about in the near term, I'm hearing that as March. I would say I don't think it's probably not the most likely case or what we would call the base case.
Here's the latest this morning. Chairman Powell throwing cold water on hopes of a March rate cut. The Bank of England decision due out at the top of the hour in about 12 minutes' time. Jennifer McKeown of Capital Economics expecting the BOE to hold but signal a pivot right in this. The BOE will probably throw in the towel on the pretense that interest rates could rise and take the first steps towards cutting rates. We've penciled in the first cut for June. Jennifer, I'm pleased to say, joins us now. So, Jennifer, we had some hawks on the MPC at the Bank of England putting their hand up and saying, we need to go one more. What is it about the data in between meetings that you think has clipped the wings of those individuals?
Yeah, I think probably most prominently the surprise in inflation, which has come down a lot further, certainly than the Bank of England was expecting. We're going to see its new inflation forecasts later on, and it's very likely that they'll need to come down quite sharply given the surprises that we've seen. So I think that's probably the big thing. Activity obviously still pretty weak as well, but I think we knew that already, and the surprises around the persistence or lack of persistence in the inflation figures.
A couple days ago, Bloomberg put out a piece showing that Britain's economists have been missing the estimate that has been put out by the Office for National Statistics time and again. Actually, they've not been able to coalesce around what actually comes to pass when it comes to inflation in the United Kingdom. How much pause do you think that's going to give the Bank of England to make anything definitive, especially at a time where inflation is still a lot higher than other places in Europe and beyond?
Yeah, there's all really good points, and it's very difficult to forecast inflation. But I think at the moment, a lot of the decline that we're anticipating, that most people are anticipating, is more or less basing the cake. The 3-month annualized type rates, the rates that are looking more at the more recent developments in inflation, already show that it's come down significantly. Yes, wage growth is still very high. It's over 6% in the UK, and the same applies actually to services inflation, over 6%. And those are both reasons why the bank won't be ready to signal strongly that rate cuts are imminent. We suspect it will end up cutting well after the Fed. But the fact that these nearer term measures are starting to ease off and that headline inflation has surprised on the downside, I think is a good reason to expect that a pivot is coming fairly soon.
Still, on January 17th, England put out their latest CPI for December, and it actually increased for the first time in about 10 months. This really caused some people to raise a question about how good the projections were and the direction that's going to follow. Do you think that that's valid, or do you think that this is just a fluke in year-over-year comps and some of the changes, particularly to energy policy?
I think that's right. And it is slightly worrying that services inflation has been relatively sticky and, as I said, above 6%. But one big surprise has been in gas prices, which the Bank of England had been expecting to remain, assuming would remain relatively high in line with futures prices. But they've come down a pretty long way. And that has been an important factor for the UK economy as well as for the Eurozone. And that's a good reason to expect inflation to keep coming down further on the headline measure. Then at the same time, we've got clear signs of an easing in the labour market, and things like vacancy rates, which should help to bring wage growth down from those very high rates that we've seen.
Jennifer, I think that Chairman Powell, often criticised, often by us as well, was actually quite transparent about how he felt about recent inflation data. He just wasn't comfortable. The 6 months of data wasn't enough for him. It's not that he wanted it to get better, he just wanted to see more of it. And then he offered up the fact that maybe, just a question mark, the last 6 months could be due to one-off factors, not a base case, but ultimately the concern is that inflation stabilises above target. When you hear things like that from the Fed chair, what do you think he meant? What could those one-off factors be that help bring inflation down to something north of 2, around 3?
Yeah, well, the one-off factors have been obviously the very sharp fall in goods inflation related to the let-up in shortages following the pandemic, and also the decline in energy inflation. And those have been the easy wins in the inflation battle for the US and elsewhere. So I think it's fair to say that the easy part is pretty much behind us. But if we look at what we would consider to be the more difficult, the more persistent parts of the inflation story, there are some really positive signs there too, that core and services inflation are going to keep coming down, most notably from the labour market. And we might see some more signs of an easing in the US labour market from the payrolls data that are coming tomorrow. But also in things like rents, newly signed rental agreements point to rental deflation in the US now. So that's a really big change, and another reason why we'd expect services inflation to come down. I think it's understandable after this period of very, very high inflation that Powell is still sounding very cautious. But it's really noteworthy that, as you said, what he wants is a continuation of this good news that we've seen, not better news. So if we just see similar inflation outturns, a similar softening in the labour market over the next couple of months, then I think the Fed will be ready to cut come May.
Here's a tough one for you. This is probably a better question for capital allocators, but I'll throw it at you, Jennifer. What do you think the number would need to be in payrolls tomorrow to really tee up a conversation about reintroducing a March rate cut, given what the chairman said yesterday about perhaps moving more quickly on softer economic data?
I don't know. We've penciled in 150,000, and we don't think that that's going to be enough to reintroduce signs of a rate cut. And labour market indicators are somewhat lagging. It may be that it's more in the inflation figures themselves that you would expect to see renewed talk of a rate cut, or perhaps moreover in activity. I think one thing that Powell and the Fed really have going for them is that they can hold off, they can wait and see, because as we know, activity has still been holding up really well in the US. Now in the ECB's situation, things are a bit more difficult because you've got evidence that inflation is coming down at the same time, an economy virtually in recession. It makes it very difficult to argue that it's time to sit and wait. Whereas for the Fed, for the time being, with activity still resilient, it makes sense to err on the side of caution. So I think if we were to see things like retail sales data start to come off very sharply, then that might be what would prompt more talk of a March cut.
It's a point well made. Jennifer, thank you. Jennifer McKeown there of Capital Economics. Bramo, unfair of me to ask in many ways, but ultimately isn't that the question we're asking tomorrow going into payrolls?
It's essentially what is going to move the market, what is going to be enough. Honestly, I think at a certain point, people want to see a rate cut. They expect a rate cut later this year. Is that going to move the market that much? I don't know.
What I'm interested with the Bank of England, do they have to come out and say something about the Red Sea? If you look at what S&P CPM had to say about the managing index, the Federation of British Industry. Manufacturing sector in England is suffering because of what they're saying is longer delays out of what's happening in the Red Sea and the Gulf of Aden.
It's a brilliant question for the next hour. Coming up in the next hour, Sri Kochagamadan of Aberdeen, Bruce Van Saun of Citizens Financial, Chris Maranock of Jenny Montgomery Scott, and Mandeep Singh of Bloomberg Intelligence, live from New York City. Equities are positive. This is Bloomberg.
What do we want to see? We want to see more good data. I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting.
I think that's the story. Is it May? Is it June? It's not March. It's pushing back because they don't want to rush into a cutting cycle.
If the economy wasn't as strong as it was, the Fed would be much more inclined to cut rates.
Markets really want to take off and put a lot more cuts in than the Fed is really willing to do.
Jay Powell thinks the runway for a soft landing's in sight, but right now that's a forecast.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning. Good morning. For our audience worldwide, this is Bloomberg Surveillance alongside Lisa Abramowicz together with Annmarie Hordern. I'm Jonathan Ferro. Your equity market bouncing back from the biggest one-day loss on the S&P since September. We need to talk about the similarities and differences between central banks. Let's take the Bank of England and the Federal Reserve. I can talk about some similarities as that decision drops unchanged. They drop their reference to the risk of further tightening. So that's the similarity, what they have in common with the Federal Reserve of yesterday. Here's the difference, Lisa. The way they vote on the MPC, that is a split vote. Some want hikes, one wants a cut.
And this comes at a time where they're having it very much out in the open. And I would also say another difference here is the economic backdrop. Very different when you have inflation materially higher than where it is in the U.S. and, frankly, growth not as rosy as it is in America.
Just to go through that vote again, 2 voted for higher rates. 1 voted for a cut. That is certainly not how things are going at the Federal Reserve. But I'll say this about Chairman Powell, and you said it too. It felt like he was herding cats yesterday, just struggling to, I would say, reflect the consensus of the committee in the news conference. And I think we got a flavour of that at the last meeting in the middle of December as well.
There seems to be a struggle between him representing the committee and him representing himself. And that sort of goes to this question around walking back some of the aspects of what he said after, and I'm thinking particularly of December. The Bank of England is unique, not only because of split votes, but also because it is a very different economic backdrop. On one hand, yes, there's just inflation. On the other hand, growth, I think, is the second worst behind Germany in terms of the developed market economies, the largest. So it's not as clear cut maybe as it is in the United States.
Annmarie, who does this sound like? Governor Bailey, evidence needed before we can cut interest rates.
Well, it sounds like Jay Powell, and also sounds like Christine Lagarde in some ways. All of these central bankers say they want to see more data. Jay Powell, though, wants to see, I think, a lot of more confidence. The BOE, I love because you actually get to know who is looking at hikes and who is looking at easing. But again, disruption to the Red Sea shipping a, quote, material risk. I'm really shocked by some of the manufacturers in England, which are saying we are seeing costs go up because of this, and the length of delivery is also expanding.
Which is the reason why I think it's compelling that the Bank of England says that they see inflation at 2% in the second quarter and then accelerating. That is different than what we've heard elsewhere and kind of puts a coda on this idea of maybe we're in a sweet spot that just can't last.
Got a fantastic lineup for you. Let's just start with a move in the FX market. The pound, just reversing losses here. The pound against the dollar, cable, 126.63. We're still negative by 0.2%, but that story's just turning, just changing in the last 10 minutes or so. The broader price action has the equity market bouncing on the S&P 500 up 1/3 after losses of yesterday. In the bond market, yields a little bit higher on a US 10-year by 3 basis points, 3.94. Coming up on the programme this hour, Sri Kochagamadan of Aberdeen on the Bank of England rate decision, Bruce Van Saun of Citizens Financial, and Chris Maranock of Jenny Montgomery Scott on new concerns about regional banks, and Mandeep Singh of Bloomberg Intelligence looking ahead to Amazon earnings. We begin with our top story, the Bank of England rate decision, leaving rates unchanged. Lizzie Burden is outside the Bank of England. Lizzie, unchanged, but ultimately this isn't boring. There's a lot in this one.
Exactly, John. And no one expected the Bank of England to cut rates yet, but it was all about the clues for the future path for rates. And there are mixed signals here. In the vote split, as you say, there's one fewer hawk in their number today, 2 voting to hike, but now we have Swati Dhingra voting to cut. And if you look back through the history of the Monetary Policy Committee since its inception in 1997, if you look at the times when they've changed direction in bank rate, it's usually 2 meetings after they go in the other, 1 votes to go in the other direction, that the majority follows. But that's harder when you've got 2 still voting to hike. So we look then to the guidance. They've dropped the language about the risk of further tightening, but they say that rates need to stay restrictive for now, that inflation risks are skewed to the upside. So pretty hawkish, actually, this. Markets might take this as a slap on the wrist for getting a bit carried away with the rate cut expectations. And then if you look at the forecast, another way that they can communicate what they think is the path ahead, they see inflation at 2% in the first quarter of 2026. So it kind of suggests that if you've got all these cuts, it boosts growth and then it boosts inflation again. So a slap on the wrist for markets. Will Andrew Bailey give us more clues in the press conference at 12:30 UK time as to the future path for rates?
One thing that I really like about some of the statements that they put out is how granular they get. The Bank of England saying that 2/3 of policy tightening has already impacted the economy, and yet still inflation risks are skewed to the upside, with inflation potentially accelerating in the second half of this year. Lizzie, do you get the sense that this is supply chain issue driven, or is this something else, whether it's wages, something else that maybe the Bank of England is hinging on and concerned about?
What they continually point to is the domestically driven inflation, the pressure from wage growth, services inflation, but also Annmarie makes a good point. There is the risk of inflation in 2024 from the supply chain disruption in the Red Sea. It's interesting as well how much they can cut rates before it actually effectively changes in terms of the neutral rate. And I was speaking to Michael Saunders, former Bank of England rate setter, earlier. He says they could do 100 basis points of cuts before it actually takes effect.
Hey, Lizzie, great to get your response to this. Lizzie Burden there of Bloomberg outside the Bank of England in the City of London. Sterling, just erasing some of this morning's losses, still negative against the dollar. The cable rate right now, 126.56. The pound bouncing just a touch. Just a touch. Joining us now is Sri Kochagovindan, Senior Research Economist over at Aberdeen, to respond to this. Sri, your thoughts on this one? And I would ask this one. You've still got people on the MPC voting for rate hikes. Before we talk about rate cuts, what do the hawks have to worry about?
I think there's a number of issues here that might be concerning the MPC. First of all, there were very good signs in terms of headline inflation. Core inflation is also easing. Wage pressure, wage growth is starting to slow. All of that is very good. However, wage growth is still elevated. And I think what they're going to be looking for is the outcome of the April wage round, pay round indexation. That'll give more clarity in terms of the sustainability of this trend. So that's one thing. Second thing, as you've already mentioned earlier on, is some of the risks in the Red Sea that might be a concern for some members. Now, from our perspective, it looks at the moment to be contained. The supply chain issues are very muted relative to what we've already been through in the course of the pandemic, Russia, Ukraine. So relative to that, this is a very low base. Demand was low, container demand was low. So it's a very different backdrop. However, there are risks that if this duration of this blockage across the Red Sea and the choke points of the two canals, if that continues for a long period of time, that could have some knock-on impacts. Furthermore, what if it actually spills over to Strait of Hormuz or, a broader escalation of the tensions? Then that could be a risk. I guess these are all factors that could be just playing on the decision for some members.
Do you already see British manufacturers preparing for those risks and hedging against them?
At the moment, what we've seen is that freight costs have escalated quite dramatically. Now, that could be some impact on manufacturing. At the moment, what we're seeing is that there are plans that they could potentially pass this through, but we're not seeing a big impact in terms of actual pass-through just yet. If we think about how much does this actually feed through into CPI, the weights across different CPI measures are tiny if we look at transportation costs. So the direct impact is muted. However, it's really the spillovers across various aspects of the supply chain. Now, again, this is very different to what we saw in the pandemic, where we had COVID restricting supply across Asia. Also, the Asian, Taiwan Straits, Korea, shipping routes, they are much bigger than the Red Sea. So the Red Sea in context is a much smaller problem, in a sense, in terms of inflation. However, as I said, it really depends on the duration of this problem that could lead to some pickup in pass-through and inflation risks. Again, muted for now, and is our base case if the tensions remain contained.
Sri, one thing that strikes me about this statement, as well as the Federal Reserve's yesterday, is this idea of the expectation of stronger growth and that not being necessarily a big problem in terms of Fed or Bank of England policy. We saw them upgrade their GDP forecasts in the latest Bank of England statement. What do you make of this shift where strong growth is good thing, good news is good news, to quote one Stuart Kaiser?
Yes, I think definitely this is good news in the sense that a soft landing, the pathway to a soft landing is widening. That would definitely be good for news. It's exactly what the central bankers want and need. I think really the balancing act here is what's happening with inflation. The headline inflation story has been very good across both UK and the US. In the UK, what we're seeing is that base effect drag from energy prices, from food prices. That has been a very good contribution. Also, thinking again about Red Sea goods prices, which had been really escalated during the pandemic, that's back in sort of flat growth or deflationary territory. All of this is very good news in terms of the overall package that the Bank of England are dealing with. So again, they are going to stay data dependent, as I mentioned. We're not out of the woods here. So an upgrade in growth is all very good, but really it's that wage story that has been the sticking issue for the UK, and that's something they will continue to really monitor closely. So again, April is quite key. Looking beyond that, there is a good chance that headline inflation moves to target after that April meeting. We could see April, May looking at headline CPI around 2%. Core will take a bit longer to decelerate, and that's really what they're watching as well, that wage story.
Sri, thanks for joining us today. Sri, Governor there of Aberdeen. I think we're talking about two central banks, two economies, Lisa. They're going to face elections pretty soon. One's on the calendar for the Federal Reserve. One isn't yet for the Bank of England, but probably will be. And then you've got to start considering the fiscal outlook. More and more attention needs to be paid to that. I don't think, and Marvin Lower State Street said this, can you really put out an outlook for 2025 without really knowing the composition of Congress, which party's in control, who's in the White House, what they're set to do for the year ahead?
It's a great point, especially because either one, and frankly, this Bank of England is dealing with maybe a different situation, but certainly in the United States, there's going to be spending regardless. There's going to be a bigger deficit. It's just a matter of where some of that spending is going to be and how big the deficit will get.
The pound continues to erase losses. The pound against the dollar, cable 126.66. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Shares in Royal Caribbean are climbing in pre-market trading after the company beat fourth quarter analyst estimates. Cruise travel is in hot demand, with the company's 2024 outlook also coming in ahead of expectations. Royal Caribbean surged a record 162% last year and is debuting a new ship, the largest in the world. Icon of the Seas costs $2 billion to build and measures 1,200 feet. At least a dozen major cities around the world are heading for a decline in residential property values this year. Hong Kong is expected to show the steepest drop, with prime residential prices likely to fall more than 10% amid high interest rates and political uncertainty. New York and San Francisco are facing similar headwinds, with both cities impacted by remote work and low return to office rates. And Formula One has rejected Andretti's bid to join the racing league in 2025, saying an 11th team would, quote, not provide value to the championship. Formula One said it was willing to revisit Andretti's bid in 2028 when they'll be able to use an engine provided by General Motors. That's your Bloomberg Brief. John?
Hira, thank you. Lewis Hamilton, Ferrari 2025. The reports of that, nothing else matters. And still no one around this table is interested. Up next on this program, real estate risks hitting bank stocks.
This appears to be not a capital issue per se, but really an issue of loan quality.
No one around the table? No one.
Well, I'm interested in the trip to Italy. I made it very clear.
Okay.
I find it fascinating, the mechanics of it.
Good. The conversation on bank stocks up next, not Formula One. Live from New York, this is Bloomberg. Live from New York City, equities bouncing back by 0.4% on the S&P 500. Here's a snapshot of things cross-asset. Yields up 3 basis points, down yesterday by double digits after Chairman Powell, and some banking stress as well. The 10-year, 394.81. In the FX market, the euro just a little bit softer, weaker against the dollar, 108.11. Under surveillance this morning, real estate risks hitting bank stocks.
This appears to be not a capital issue per se, but really an issue of loan quality. There are going to be numerous announcements of this is a very large provision that we're taking, always sort of in the context of we're trying to get everything out of the way at once, and this is all of it. There's never just one cockroach. So usually when someone says this is all of it, it may not be all of it.
Here's the latest this morning. New York Community Bank rebounding this morning after falling as much as 46%. A pair of troubled real estate loans contributing to a surge in its loan loss provision. A bank in Japan warning of significant losses in U.S. commercial real estate investments, while in Europe, Deutsche Bank more than quadrupled its U.S. real estate loss provisions. With us around the table this morning, I'm really pleased to say, is Bruce Van Saun, the CEO of Citizens Financial Group. Bruce, good morning to you, sir.
Hi.
You've got a strong story to tell. We'll talk about that strong story in a moment. Can we just begin with the stress of yesterday and the stress of last year? Have we put behind the difficulties of last year for the rest of the banking sector?
Yeah, I'd say for the most part, everything's in the rearview mirror now. So there were a few idiosyncratic bank failures that related to the business model and how fast those banks grew, and then the stress caused by the Fed raising rates very quickly. And so I think as the year went on, people could differentiate between the traditional regional banks and how well they've managed and been able to handle their interest rate risk. And so deposit pressures eased as the year went on. And so things are starting to feel a lot more normal. So yesterday's announcement on NYCB was a bit of a surprise. I think that's an outlier.
The monster's under the bed. It spooked people, though. You know it did, Bruce. Commercial real estate has been something that's been on people's minds for a long, long time now. Do you think we have realised the unrealised losses there yet? Are we about to see a big increase of provisions from some of these lenders with big exposure?
Yeah, I think, in that particular instance, it was more than just commercial real estate because also as banks grow in size and they enter the new weight category, they have to do a lot around capital, liquidity, and funding. And so I think the regulators are having that bank deal with those issues, and that's going to depress the net interest income and profitability outlook, and they cut the dividend as a result. So there's a number of things that play besides just commercial real estate. From my standpoint, our commercial real estate book looks pretty good. The one area we're focused mainly on is the office sector, and given the slower return to office trends, et cetera, combined with the higher interest rates, it's put a squeeze on that sector. But that's been relatively predictable and manageable for us. We have a certain number of loans that are coming due every quarter. We're looking through the front windshield at what's going to happen this quarter, next quarter, the quarter after that. And all of our people are working with those borrowers to come up with solutions that work for them and work for us. So we are charging off a certain amount of loans every quarter as we work through that. But I think we have it boxed and don't expect any material surprises.
There's your bank, and then there are other banks. And I am curious, in terms of especially Aozora, the Japanese bank, also reporting unexpectedly large losses from U.S. properties. Barry Sternlicht of the Starwood Group was talking about how there could be potentially $1 trillion of market losses taken off of the office space property. Do you think that that's a valid reflection of losses that have yet to be taken down, not at your bank, but more broadly with the good actors and the bad actors and potentially even more regulatory pressure from Washington?
Yeah, it's hard to predict in the round how big that's going to be. Certainly, if rates come down as they're expected to, that's going to be beneficial to the commercial property space. And then if return to office picks up, which we're starting to see signs that that's happening, that could also be beneficial. So, real estate is very localized. So each building has its own story. It has its own rent rolls. I think what we've tried to do is stay very diversified and stay more in the suburbs and in the central business districts, stay more at the A-class and B-class buildings and away from C-class buildings. So there's certainly going to be some pain based on location and the dynamics around the building and whether it's a C space. And so there'll be some losses. But I think for the super regional space that we operate in, I think all those will be manageable. I think we'll be able to deal with those reasonably well.
I wanted to ask about the geography. Is this idiosyncratic to New York? We've seen everyone or a lot of places move. People are going to Nashville, Miami, Denver. Or do you think potentially there could be ripples across the United States?
Yeah, I think some of the bigger markets like New York and San Francisco and Chicago probably have the biggest pain factor right now. But we're also seeing some early trends that leasing is starting to pick up, and the city feels better. It feels more vibrant. So I wouldn't write off New York City.
You've been on the front foot expanding in New York City. Talk to us about that expansion. What are the plans for the New York metro area?
Well, we I guess since our IPO almost 10 years ago, we had this dream, I guess it would be, that we would be able to attack the New York market in some way, because we were big in New England and in Mid-Atlantic, but we kind of had this hole in the donut, if you will, which was New York City. HSBC decided they wanted to exit their East Coast retail, and that was a big presence in New York. And then Investors Bank we didn't think HSBC by itself was enough, so we went out, called the so-called 1-2 punch, and bought Investors shortly after we closed on HSBC. And that gave us 200 branches in the New York metro area, about 1 million new customers, top 10 deposit market share. And that's gone phenomenally well. I'd have to say, in terms of account growth, customer growth, deposit growth, we're shooting the lights out there. Hopefully, if you live here in New York, you get to see our nice bright green signage.
I see it.
It's good for our overall brand visibility as well to be here in New York. So we finally now can say we're a strong Northeastern bank, and we filled in that hole.
Are you filling in more holes? Are you planning on more acquisitions?
Well, the other thing that I think we've done in the past couple of years, which is pretty exciting, is last year we had an opportunity to lift out a bunch of teams that were leaving First Republic. And so we brought about 150 people onto our platform. That was 6 teams. We started out focused on the East Coast, a Boston, a New York, and a Florida team. And then the West Coast teams also said, well, what about us? You should be out here, too. So we brought 3 teams over from the San Francisco and Silicon Valley region. And we had purchased an investment bank about 3 years ago called JMP Securities, which is a really well-run, highly respected shop. So in the West Coast there, we're kind of thinking we can go at that market over the top. So with JMP and with these high-end private banking teams, we know everybody in PE, VC, innovation economy, and we can go in without the full ground game. In New York, we have the full ground game because we have the 200 branches. So a little different strategy, but interesting opportunity for us, I think.
That innovation economy has been absolutely hammered recently, which opened up the door, of course, to go to First Republic and make those acquisitions of those teams. Is it bouncing back? Are things getting better?
Yeah, I think it will. Everything goes through cycles, and you look at the high rates putting a crimp on a lot of investing activity over the last 2 years. So we probably had 8 quarters. Usually these things run where you run soft for about 7 quarters. We hit the 8th quarter and the 4th quarter, and everybody's kind of waiting for Godot. Okay, when is this going to pick back up? We're seeing signs already in the 1st quarter that markets are open. Lots of conversations are happening. Deal pipelines are filling up. So hopefully that just continues to flow through, and it turns out to be a bounce back year in the capital markets.
We've heard a lot of this, Lisa. We heard this in Davos as well. The banking business bouncing back, coming out of recession. 24 into 25, 26.
No, but it feels like there's a lot of pent-up demand. I mean, how many PE investments haven't had their exits for a long time? I keep hearing about that again and again. So, the question is just whether the market will cooperate.
Bruce, you're going to stick with us, I'm pleased to say. Bruce Van Saun there of Citizens Financial. If you are just joining us, your equity market on the S&P 500 is slightly positive by 0.4% after yesterday's losses. Coming up shortly, Mandeep Singh of Bloomberg Intelligence previewing mega-cap tech earnings due out after the closing bell. We'll hear from Amazon, Apple and Meta. All of that and more from New York. This is Bloomberg. Bouncing back this morning. Good morning to you. Equities positive by 0.4%. 2 days of weakness on the S&P 500. Yesterday, big time. Biggest one-day loss since September on the S&P. On the Nasdaq, biggest one-day move lower since October. This morning, higher by 0.6% on the Nasdaq 100. 3 names making up about 12% of the index on the S&P 500. Apple, Amazon and Meta reporting after the close. That's the equity market. Here's the bond market picture for you. The 2-year, 10-year, 30-year shaping up as follows. Yields bouncing back too here, Lisa, up 3 basis points. The 10-year 394.24.
We learned a little bit yesterday, but not that much from the Federal Reserve. Basically, maybe March is less likely, but still they're moving into a cutting posture, and the market seems to be adopting that with this idea that we can continue disinflation even in the face of growth.
I like the Stuart Kaiser takeover at Citi. The Fed created some volatility without materially changing the base case outlook. Isn't that the truth for the last 24 hours or so?
You could basically say that they didn't give us anything conclusive that we didn't already know, but they pushed back a little bit just on the edges of market pricing, which is probably beneficial to their ultimate goal.
I'll throw in Peter Cheer as well of Academy Securities. I was just going through the reaction yesterday on the south side. While the punch bowl wasn't completely taken away, it was put out of reach. I think it would take the markets a day or two to accept that. We're accepting it this morning. Stocks are positive, yields a little bit higher. I'll finish on foreign exchange for you. The euro looks a little something like this against the dollar. We are just about negative on the euro at the moment. 108.15 on the euro. The pound cable 126.74, almost unchanged on the day now, negative by 0.1%. Under surveillance this morning, central banks holding steady. The Bank of England opening the door to rate cuts, but 2 members of the policy committee calling for another hike. This on the back of the Fed's message, not so fast. Chair Powell saying, quote, "We're not declaring victory at all. I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting." Bramo, we need more evidence, apparently.
Or at least we need evidence that's the same for longer. This idea that there is a concern that maybe they're missing something, and how much is this born out of the mistakes that have been made in the past. At the same time, ultimately, he's basically confirming what everyone knows. They're going to cut rates. If it's going to be May, okay.
At some point.
At some point, but in the near future.
Bruce Van Saun, Citizens Financial Group CEO, is with us around the table today. Bruce, what did you think of yesterday in that news conference?
I think there were no surprises. He was appropriately cautious, and I think he wants to push out the notion that the next cut is in March and say it may be at the May or June meetings.
How much does a rate cut grease the wheels for you, the business? Does 25 basis points get it done, 50, 75, 100?
Yeah, I think he should go gradually because they don't want to have to turn about and then have a hike. So I think they'll put their toe in the water and start with 25 and do a series of 25s.
Lisa, I asked this question because we always talk about March, the importance of going early, but ultimately, does it move the dial to go 25? Then 50.
Anyone who's trying to plan a business model says no. I like that you rattle it off like auction numbers. 25, 50, 75, 100. What gets it done? How are we doing?
Just trying to see what the bid is with Bruce, that's all.
Exactly. Where are you going? Where do you bid? But, this is the thing. It's ultimately how many cuts they're going to get done, not necessarily if they're going to start in March or if they're going to start in May.
Some news out of Washington. Let's turn to that. The House passing a $78 billion bill that could hand President Biden an election year political victory. The bill provides child tax credits for families and restores expired tax breaks for businesses, allowing them to quickly recoup R&D costs. The bill now heads for vote in the Senate, where Mike Crapo said Republicans could offer hundreds of amendments. So, AMH, help us with this one. This one is happening or it's not happening?
Well, it looks like it's on the path to potentially happen. I was struck by the vote count, 357 to 70. This is a House of Representatives that's been stymied with dysfunction, and they're able to get a tax bill done. But we heard from Chuck Grassley, the senator, talking about the fact from Iowa, talking about the fact that this would give Biden a huge win. And they're questioning why would we do that. But it's less controversial, say, than the border deal. So I think there is more hope for a tax deal.
Bruce, favourite part of the programme when we ask about politics and guests trying to ignore it. That's going to happen right now. 2024 elections, how important are they to your industry?
I think they're quite important. We'd like to see strong economic policy that going forward, and probably a little bit moderated view on regulation. But what I would say is the banking industry historically just makes the pivots and adjusts to who's ever in power. So I think we can certainly deal with another 4 years of Biden, and we could deal with 4 years of Trump, which we've already had in the past.
Are the proposals, though, that different? And I guess this is something that we've been talking about a lot in terms of the deficit and some of the, different policies that would come down the pike. How different is
well,
this? Well,
the funny thing is, you don't really hear that much about substance and policy. When you see these guys talking, they're kind of throwing mud at each other, but they're not really telling us what they're going to do for the country and what the policies they'll affect.
There's a feeling we'll get a softer touch on bank regulation if we get another Trump presidency. Can we talk about the regulatory proposals on the table right now? What do you think of them? Do you think they appropriately confront the risks that we went through last spring? What do you think of them?
Well, I would say historically, anytime there's an incident or there's some turmoil, the regulators come with a toolkit, and usually the pendulum will swing too far, and then it needs to be dialed back. And I think we're going through that process. So the knee-jerk playbook is banks need a lot more capital. Okay, well, how are you going to go about that, and what are the second-order consequences, and is it going to reduce the supply of credit, and who is it going to harm if that happens? And so I think they put it out there for comment, and the industry's commenting, and politicians are looking at it. So my expectation is that things will be dialed back some as we go through that process.
Have you been surprised the focus has been on the larger banks when the larger banks seems to be the port in a storm last year, and it was the smaller banks that got into trouble?
Well, I think there's still the residue of too big to fail. And so if you aren't sure, 100% sure, was this a broader regional bank crisis, or was it just isolated to a few banks that grew too fast and had undiversified business models, you shoot first and ask questions later. So I take my money and put it in one of the mega banks, even if they're not paying me great rate of interest, but the government will never let those banks go down.
Deposit insurance. Do we need to see reforms?
In which?
For deposit insurance.
Deposit insurance. I think it would be good if we could cover companies' operating accounts because they're not rate shopping between banks, and they need those services provided to them. And so I think if those were covered, that would create more stability. But that's difficult to achieve politically, so I'm not optimistic that that'll happen.
That's the politics down in Washington, Lisa. I think the broader assumption right now is that they water down this proposal for much, much stricter, stringent capital requirements.
It's wildly unpopular, and it also is. Regional banks, they're going to see a lot more pressure if they have to comply with regulations that are fit for JP Morgan rather than just some of these smaller banks. And I mean, we already are seeing it with New York Community Bank. They had to change the regulatory capital in response to hitting a new bracket. Who's next?
It's so true. That's the banking sector. Let's talk about tech. Mega cap tech earnings resuming today with Amazon, Apple, Meta reporting after the close after a big year of gains. AI set to be at the forefront once again. Some analysts have perceived Amazon Web Services as lagging behind Microsoft and Alphabet in generative AI, two companies that failed to meet lofty AI-fueled estimates earlier this week. Mandeep Singh joins us around the table for more from Bloomberg Intelligence. Mandeep, good morning to you. Let's talk about expectations for later on this afternoon. What are they?
Well, so in the case of Amazon, clearly all eyes are on the AWS growth number, which is decelerated sharply if you compare it to Microsoft Azure at 30%. We are comparing it to 12 to 13% growth for AWS. And in the case of Meta, I mean, look, this is a company that had almost 80% drawdown, reclaimed its 1 trillion market cap, and now everyone is expecting, they have course corrected. Metaverse has become a sideshow, and they're pivoting to AI, which they have. But they're still losing $15 billion a year on Metaverse, which nobody knows what they're losing on. So I think the call will be interesting to find out if that has changed.
Maybe they'll change their name to AI, right? It sort of will be the latest thing. I'm just curious, how much we're going to see additional job cuts and things of that nature, because that was really what triggered some of the rally, was this sort of right sizing, whatever that phrase is, that Meta put out there. Do you expect more of that?
Well, so they did pretty big round of layoffs last year, and my sense is they're done with the cost structure optimization. Now the focus is on top line, and look, they are expected to grow 21% this quarter, so that's very healthy. When you compare it to others like Snap and Pinterest, they're still growing mid to high single digit at best, and that is where there's a disconnect. Online advertising is a very cyclical industry. If these companies are growing north of 20%, then Snap should catch up, Pinterest should catch up, and that's where I feel like in the case of Meta specifically, their user growth is low to mid single digit, engagement is low to mid single digit, but they're growing top line 20% plus, and that's a function of all the ad loads that they have increased. They're stuffing the feed with more ads. That's working for now, but clearly there will be a pushback in terms of engagement. At least that's how I look at it. Like, it's not as if you can keep showing more ads and people will be okay with that.
We have a Bloomberg opinion piece out today from Dave Lee saying, when it comes to Apple, iPhone makers never face this many uncertainties at the same time. What does Tim Cook need to say today?
Well, so in the case of Apple, look, all these companies had a decline in EPS last year. When you look at Meta and Google, also had a sharp deceleration. Apple was steady. Look, they're not growing top line, but because of the huge buybacks they do, their EPS growth has been still steady. And the main concern around Apple is how do they grow top line because of the China factor. Look, the units are declining, there's no doubt about it, but they're made up with higher ASPs. They're selling the higher end phone more and more, and that has somewhat offset some of the unit decline. So it's about unit growth, and Vision Pro, it's a new category. I'm glad they announced a new category, because for the longest time, people were like, what's next with Apple? So at least there's something on the horizon. I don't think it's going to be as big as your smartphone category, but at least there is something new to talk about.
Mandeep, you've talked about how Android over at Google would integrate AI. How's iOS going to do that in the years to come?
I mean, Apple hasn't even talked about large language models or generative AI.
Isn't that odd?
It is odd, but they've always been like that. Even when machine learning was the rage, they never really talked about machine learning that much. And so Apple does things quietly. They've done so much at the chip level, the vertical integration. So to me, they will catch up. Yes, they are behind in technology. Probably I've talked about this on your show. They need an acquisition. There are so many companies that are developing large language models. That would help. But the key concern is that services line. That is the profitability driver. And over there, half of their revenue comes from App Store. That's coming under pressure from EU, saying you can't. And to me, that is the part that worries me the most with Apple.
Bruce, that's Apple. Let's talk about AI. As a bank, how are you integrating some of these new technologies that we've all been talking about over the last year?
Yeah, so we have an AI group inside the bank, and we're looking at launching. We've already launched 3 or 4 use cases, which allows us to start to test and learn. So, for example, how we serve folks that call into our contact centers, and have using that predictive analytics about how to execute those calls more efficiently and more effectively. So there's a number of places in the bank that we're going to be rolling that out. And then as you have some success, then you figure out, what are the next things down the list and how can you be even more impactful with the next things. But certainly the potential for kind of game-changing impact in terms of customer service and cost efficiency is all there. It's all in front of us.
Cost efficiency is going to ring some bells in people's minds in terms of how many people are not going to have a job because of artificial intelligence and how it changes the mix of the people you'd hire.
Yeah. Well, what's interesting, I just look at us, Citizens, since we to our IPO, we had about 18,000 people in the company. We've done several large acquisitions, and we've also just grown organically, but we still have 18,000 people. So we have people in different capacity and more customer-facing people than we did back then. And so I'd like to, continue, be on this journey of continuous improvement where we can take out more manual processes, and then we can reinvest in things that help us grow the bank and better serve customers. So I think that churn is what you're going to see. I'm not sure you're going to see a big reduction in employment, but you'll see different kinds of jobs inside the banking system.
I think it was Jamie Dimon who talked about working fewer days in a working week?
3.5.
3.5?
That's what he said. Yeah, I was looking at it because I was like, if he's going to lead the way,
I can't
potentially.
think of any time in human history over the last 100 years where we've taken a technological advancement and worked less. We've just taken that productivity boom and worked even more with it. Is that going to change?
Yeah, no, I don't see it. I mean, sometimes Jamie just says some things to be amusing. I don't think he probably in his heart of hearts thinks that's going to happen because people, this country has a high work ethic. We're very industrious people, and if we gain a little more free time, we figure out like what else can we do with it.
Totally.
A lot of times it's not sitting by a pool or being out on a golf course. It's like, let's get on to the next kind of business that's interesting. Let's innovate. Let's do some more great things.
We're on the same page. Brammer, I feel exactly the same about this. It's human nature. It's human nature. Three-day work week.
Okay, it's not going to happen. But what's going to happen is some people are going to work a whole lot more, and some people are going to struggle to be employed.
True.
And I think that really is what I think maybe needs to be focused a little
Needed
more
that Brammer-esque take on it, and that's absolutely right.
So
Mandeep's good to see you. Mandeep Singh of Bloomberg Intelligence. Let's get you some more stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Boeing CEO Dave Calhoun has admitted the company, quote, caused the problem behind the incident that saw a door plug blow out during an Alaska Airlines flight. Speaking on the company's earnings call, Calhoun said an investigation into the cause is still underway, but the ultimate responsibility, he said, is on Boeing. The plane maker said it would not provide a financial forecast for the year. Elon Musk is going all in on Texas, seeking shareholder approval to move Tesla's corporate registration from Delaware to the Lone Star State. Musk took to his social media platform X to poll users on the change before saying Tesla would soon hold a shareholder vote. It came after a Delaware court voided the CEO's $55 billion pay package, calling it excessive. He's already moved Tesla's home office to Austin and relocated himself and his charity to the state. Universal Music Group has begun pulling its artists' music from TikTok after failing to reach a new licensing deal. That means TikTok users will have to find alternatives to music from the likes of Taylor Swift, Drake, and Bob Dylan. In an open letter, the world's biggest record label said negotiations stalled over disagreements on compensation for artists and protections against AI tools. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, regional bank stocks under pressure.
I do think that overall regional banks are going to be weak in the months ahead on the back of this news.
That's coming up next, live from New York City. This is Bloomberg TV. Equity futures near session highs on the S&P 500, up by 0.5% on the S&P. Yields a little bit higher by 2 basis points on the 10-year, 393.49. Under surveillance this morning, regional bank stocks under pressure.
In some ways, it's easy to say that New York Community Bank Corp stands alone and that this is a problem that's really idiosyncratic to that bank. But I think that the problem arises that as we go through and see more and more of these idiosyncratic events pop up amongst the regional banks, that's a cause of concern. I do think that overall regional banks are going to be weak in the months ahead on the back of this news.
Here's the latest this morning. Wall Street scrambling to take the temperature of U.S. regional banks following a dismal earnings report from New York Community Bank. The bank sliding a record 38% yesterday after saying it would have to hold more money to cover losses in commercial real estate loans. Chris Marinac of Janney Montgomery Scott writes in this: every bank above $100 billion in assets must plan for tougher capital standards. We think the bank credit cycle is still early innings and more issues will unfold. Chris, I'm pleased to say, joins us now for more. Chris, let's get into it. First question, do you think this is a New York Community Bank Corp issue or a banking sector issue?
John, I think it's a bank sector issue. Every bank has a certain amount of problems. We call that the frequency of problems. We think that will rise the next 2 years. It's still early innings in the process of recognizing credit risk. And then we transition to the severity of losses, which I think will be lower than investors fear. But the problems and the recognition is still happening. That's exactly what happened with New York Community, in addition to their decision to cut a dividend and in addition to build more liquidity.
Is your concern centered around banks of a specific size and region, or is this just more broadly that people are going to get increasingly concerned about commercial real estate values that haven't been fully written down, and it'll pressure the stocks regardless of what the details are under the hood?
Sure. Every time we go through a credit cycle, whether it was in the early 90s, the early 2000s, the most recent great financial crisis, all of these times you have to recognize risk, set up reserves, and then take the losses. So I think the concern is across the board. I think it varies by the type of loans you do, but it's not just commercial real estate. It's going to be typical C&I lending. It'll be some consumer. It'll eventually be residential if prices come down in residential down the road. So I think we have to be prepared to recognize risk, build reserves, and then eventually take charge-offs. I think the ultimate charge-off rate is going to be a lot less, but I think the recognition of issues is still happening. And I think it's particularly keen in certain commercial real estate types like multifamily, which have been pristine and are no longer pristine. And that's sort of the exact prescription of what NYCB had to recognize. But I think they'll do more of that in the next 2 quarters, and then eventually it will start to repair as time passes. A lot of these borrowers are stressed by higher interest rates. If interest rates back off just a little bit on the 5-year Treasury, for example, it's going to make life a lot easier for them to get through. And that would be how I think this plays out.
Bruce?
Yeah, Chris, nice to see you. But I guess what I would say to that is that, the traditional super regional banks all reported in the last 2 weeks and really were pretty optimistic. Like we'll grind it out for another 2 quarters, but then things should pick up in the back half of the year as the economy gains some steam and the Fed starts to cut. And in terms of credit, folks were kind of giving charge-off guides that were pretty manageable, and we've already built a lot of credit reserves. So I would say the markets have responded favorably to that, and and to me, I would view New York Community as an idiosyncratic one-off. They attempted to do a lot in a very short period of time, buying Flagstar Bank, buying Signature Bank, lifting out a bunch of teams. And so they're like acclimating to kind of that bigger size and all that goes with that. And they did have a very strong commercial real estate focus in terms of their loan portfolio and the dynamics around that. And they had a very high loan to deposit ratio. So there's still actually more work for them to do. Traditional banks, it kind of irked us last year when people called it a regional bank crisis. It was the West Coast banks that grew too fast, that weren't diversified. That's where the problem lied. And then it's guilt by association. Well, if you have a similar asset size, you must have the same problems. From where I sit, we don't have anything like the same problems. And I think you'll see that 24 will be a year that gains steam as the year goes on. And we're setting ourselves up for a really strong 25, 26, and 27.
So, Bruce, I agree with your points completely from the standpoint of low charge-offs, and I think the particular issues that set up with SVB and First Republic and Signature last year. The only point I would kind of contrary is that as 10Ks are filed in 3 or 4 weeks, I think we're going to see that criticized assets do go up from September to December. And that's really more of loans that used to be pristine that are now on watch list or a few downgrades to substandard. It doesn't necessarily change the charge-off guidance. And I think your point's really well taken. Charge-offs are still low and expected to be low. Even the largest banks with big consumer books are going to have 45 basis points of losses this year. And that pales to the 150 to 200 points that they wrote off in 2009, 10, and 11 when you had these extremely high loss rates. And I don't see that happening at all. But I think it's the recognition that pass-rated loans become non-pass, i.e. criticized, and that's where the reserve building still has to happen. Obviously, in New York Community's case, they had to catch up from used to be 40 basis points pre-signature to now being 80 and then now 125, and that brings them back to peer. And because they're graduating to $100 billion today, they have to be at peer. That was the primary change that the reserve was related. But the liquidity piece is still ongoing.
Yeah.
My concern is the Fed's liquidity stuff is going to continue to throw curveballs at the industry.
Hey, Chris, great to catch up. Chris Marinac there of Jenny Montgomery Scott. Got about a minute left, Bruce. Your final thoughts on that?
Well, the one thing I agree again with some of that perspective, but We made a point in the fourth quarter earnings call to say we've started to see criticized assets stabilize. So I actually think that we're starting to feel more positive that we've identified where the issues are, and they're not continuing to grow as we go through 2024.
Interesting. Bruce, it's good to see you. Thanks for being with us. We've got to do this again. Bruce Van Saun of Citizens Financial, just sort of flipping the table, Bramo, and taking on the analyst.
I love
Instead of
it.
the analyst taking on the bank.
It's perfect. It's
got
actually
time for
really,
that as well.
Yeah, that's I think we're very valuable. We should do it again.
Got to work it out, haven't we? This is a big, big issue we've been talking about now for about 12 months.
Yeah.
I also wonder how many banks are on the precipice of that $100 million level, that threshold, where suddenly they have to report in a very different way and have different capital requirements. Those might be the idiosyncratic ones that we need to be watching.
Let's set the stage for the next hour on Bloomberg Surveillance. The third hour just around the corner. Coming up on the programme, Mike Wilson of Morgan Stanley, Herman Chan of Bloomberg Intelligence, Stephen Stanley of Santander, Pierre Ferragut of New Street Research on tech earnings. A little bit later, the reaction to the Federal Reserve, the stress in the banking system, if you think there is any, the stress in the banking stocks of yesterday. We'll build on all of that. Equity futures right now on the S&P 500 positive by 0.5%. Yields a little bit higher by a basis point or two. On your 10-year, 392.92. From New York City this morning, good morning. The third hour of Bloomberg Surveillance up next.
Markets have been rallying strongly, not just in mega cap tech, but broadly speaking, over the last 2 or 3 months.
This has been more than a tech-driven rally. It's just tech has sort of over-rallied versus the rest of the equity market.
It's absolutely critical that tech can hold up here. We still have the AI preference, and Magnificent Seven is expected to grow their earnings by 21% this year.
That's where we think the excitement will come this year as we see more efficiency coming through for tech stocks.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
90 minutes away from the opening bell, live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance alongside Lisa Abramowicz together with Annmarie Hordern. I'm Jonathan Ferro. Your equity market bouncing back by 0.5% following the biggest one-day loss on the S&P 500 since September after Chairman Powell pushes back against March rate cut calls.
Okay, so he pushes back on one hand, but he giveth to the rest of the year, and sort of suggesting that he believes in the immaculate disinflation. So he taketh and he giveth, because right now people are expecting the Fed to cut rates this year. He confirmed that. The question is just when they start.
Throw in a bit of bank stock stress of yesterday. Still can't believe this. Need to go over it again. Why wasn't that talked about in the news conference? It was dropped from the statement. Clearly, it was a big part of the move in the bond market in anticipation of the Fed decision going into the news conference, and then tumbleweed for about 60 minutes. No talk of it whatsoever.
A lot of talk about other things like the terminal rate and some of the inflation concerns and some of the idea of the strength in the economy. The issue here is this idiosyncratic or is it systemic? Have we seen the full effects of a correction in commercial real estate prices, especially given the incredible overweight that a lot of these regional banks have had previously?
You guys know what I think. No journalist was going to come out and waste a question on something that was just developing when they know Jay Powell's probably going to say, I don't have enough to really have a substantial statement to say on that. And likely he would say this is idiosyncratic to this New York bank.
Is it idiosyncratic? Commercial real estate stress, unrealized losses, provisions? How idiosyncratic is that going to be?
It's idiosyncratic in the sense that each loan has its own issue. But the fact that you've got, Barry Sternlicht coming out and talking about $1 trillion of market valuation losses on some of the office space real estate market that could be near $3 trillion before the pandemic raises some concerns. Who's going to be left holding the bag?
If you get enough idiosyncratic issues piled on top of one another, you've just got a big issue, haven't you?
I think that's called contagion.
Well,
right?
Okay, but it might be contagion that's already priced in. I mean, it's not exactly as if the KBW regional bank stock index has been absolutely flying. I mean, it's been decimated. So how much has already been baked in at a time where arguably we could be getting people back to the work? Everyone's calling everyone back to the office. I mean, UPS saying everyone back in.
I see those headlines. You know what
Yeah.
I think? I can't believe those headlines are still out there. Like, that's still a story. People haven't gone back to work yet. That's still a thing.
Get back to the office,
Still
Jonathan Ferro.
Kind of bizarre.
Prescribing. I know, but this is a shifting kind of sphere where people are realizing.
If you want to succeed, no, I'm not going to do that now. Equity futures on the
But
S&P
later.
500, just about positive by 0.4%. We are just a little bit firmer. Yields higher by a basis point or two. No one needs that, Lisa. 392.92 on a 10-year. Coming up this hour, Morgan Stanley's Mike Wilson on Wall Street's post-Fed reality check. Stephen Stanley of Santander previewing the January payrolls report. And New Street's Pierre Ferragu looking ahead to Apple earnings after about a little bit later this afternoon. We begin with our top story, Wall Street's reality check. Fed Chair Jay Powell saying not so fast when it comes to rate cuts. Morgan Stanley's Mike Wilson writing this. The data tell us growth and inflation are slowing directionally, and the Fed will be easing this year as a result. Under such conditions, quality growth outperforms. When in doubt, it pays to go with the highest probability winner. In this case, it's high-quality growth. Mike, I'm pleased to say, joins us now for more. Mike, it's good to see you.
Yeah, great to see you guys.
Good morning. Fantastic to have you with us around the table. We'll get to stocks in a second. I want to talk about the outlook. A convictionless outlook was a theme in a recent note of yours. How convictionless are things right now?
Well, look, we spend time with clients all the time. That's what we do for a living. And I would just say that, we had this big rally after, the pivot. And I would say it started with the Treasury squeeze when they said they're going to issue less coupon. So it was really a duration rally that then fed into a stock rally. And so now valuations are stretched again, and people are looking around going, okay, what's next? What's the next catalyst? I think there's going to be a couple things that will determine the direction. Number one, how much deceleration do we get? Okay, what is we'll come back to this banking question. I think that's, to me, that issue is not a systemic issue. What it is it's a weight on credit growth. Okay, like the regional banking system is just not lending at the same rate that they were because they're constrained, and that's been our view all along, which means quality stocks will continue to do better, right? The companies that are reliant on that kind of funding are going to continue to see that's a paperweight for them. And I think that's the main takeaway from the banking situation. And then, of course, new themes will evolve. Last year was about two main themes, right? It was about GLPs and AI. So can those two themes continue to drive the stock market? Yeah, to some degree, but it's probably going to morph a bit, and then there'll be new themes. And I think that's what investors are looking for now, looking for new themes to kind of latch onto in a world that's going to remain macro uncertain, is the way I would say.
Can you identify any themes right now?
Well, I think the AI theme is the one, instead of enablers, we're going to adopters, right? So that's probably the biggest theme we have as a firm. The GLP one is sort of positive and negative, as we've seen, and that's a great thing for long-short investors. And then I'm wondering if we're going to get some growth out of the international markets finally. International economies have not really recovered from the pandemic yet, for the most part, and I think that's a wild card. So if that were to happen, that could be a great theme for EM. It could be a theme for things that are levered more to global growth as opposed to just the U.S., which has really been the only engine of growth.
Since you say that you fly around and you talk with clients, I was just noticing some of your recent travels. You were recently in Miami.
Yes.
I imagine you're getting a lot of points, by the way. You talked about the AI stock, saying, I think it's the Magnificent Four now, and it's related to earnings. Who are the Magnificent Four? Who gets dropped?
Yeah, well, I think it's, we're not talking about specific names, but I think it's obvious. People have been talking about this too. I'm not the only one, right? We're seeing, you can identify which stocks have fallen off. But what we look at is earnings, okay? And I would say there's a Magnificent One, quite frankly, that has real top-line acceleration growth. Everybody knows what it is. And then the other ones are been more cost-cutting stories.
It rides with NVIDIA?
Yeah, and my sense is that what we're going to see here is a broadening out in quality growth. So in other words, when we do our screens on quality growth, only 27% of that basket is in IT. Another 10 or 12% is in comm services. So that leaves another 60 to 70% of the S&P 500 that kind of qualify for that high quality growth bucket. And that's what should happen. We should broaden out if we have a soft landing that doesn't have other issues. And that's the other thing that we've been really trying to help clients with, is give them a framework on the macro. That's what we do, and say here are the three buckets. Okay, soft landing with decelerating growth and decelerating inflation. That's kind of what we had last year. It's high quality growth. A soft landing with accelerating growth and maybe stickier inflation. And that's an environment where you could see a broadening out, perhaps to lower quality areas. And then the third scenario is still a hard landing. I mean, we can't eliminate that. And I think that's going to be how, that's going to determine how you position your portfolio from a stock standpoint.
How do you hedge if you are cautious and there is this uncertainty? Is it energy stocks? Is it more duration sensitive stocks? I mean, how do you even understand what it means to hedge when you have such bipolar types of outcomes?
It's diversification. You got to be diversified. Now, one of the things we talked about at this conference as well, which didn't make the headlines, is this idea that we finally have very attractive real rates. and nominal rates to some degree. So from a portfolio construction standpoint, okay, this is the first time in 15 years where you can bonds actually provide their diversification benefit. And we saw that yesterday, right? Bonds rallied, stocks were down. So, we're very bullish on, we've been bullish on duration since 490 on a 10-year. I mean, so here we are, whatever, it's probably not as good a value, but in the event that something systemic does happen, there's another shock to the economy, that bond portfolio now is, the yields are high enough where they can actually provide some diversification to your equity risk, which means you can take equity risk, still up the quality curve, okay? So it's a diversification between stocks and bonds, and then understanding what within the equity market you feel more comfortable with. If things get better on the economic front and we see better growth, then we can go out the risk curve in equities. We can take more equity risk as long as we have that duration benefit on the bond side.
You mentioned that change in theme from AI enablers to adopters. Where should I be looking for adopters? What does that mean? What does that look like?
Well, it looks more non-tech, right? So who are going to be the early adopters within, the adoption of tech, AI as a cost, benefit, as well as driving new growth. Now, we've written about this already. We think it's more of a 25 story.
Okay.
Like the productivity story is really 25. So we're not that bullish on earnings this year relative to the street. Street's at like 244, bottoms up, we're 230. That's the typical pattern. It will probably come down to our 230. But then for next year, we have 266. That's 16% growth. And a lot of that's going to be driven by productivity improvements as this is adopted. I don't think this is a first, second, third quarter, even fourth quarter. It's going to take a little bit of time. But our analysts, we wrote a report recently, bottoms up report, identifying the potential winners in that. And the market will probably start to sniff that out sometime during the year. They're not going to wait all the way until 2025. But that runs the gamut of industries away from tech.
Are they labor-intensive industries?
They can be. It can be labor intensive, but it can also be growth drivers. I mean, like if you use AI to, as an effective way of marketing, like it's a cheaper way of marketing to get new customers. I mean, we don't know yet. This is what's exciting about it. It's also uncertain. There's also going to be a lot of losers. Okay. Now, one of the things that worries me a little bit about AI in the short term, we've seen a lot of layoffs recently within the tech sector. So, maybe these guys are already seeing the benefits and they're able to remove headcount. So, the labor market, I think there's various views on the labor market. I mean, our view is that it's slowing, it's weakening, a lot of government jobs, a lot of healthcare, social worker type jobs, which are somewhat government related. And if companies get efficient, this could be an interesting catalyst actually for more layoffs potentially. So it's going to be uncertain, right?
Okay, I just have to ask this because I get messages all the time. You're such a downer. Why are you so pessimistic? When you go around and you're talking to different clients, how much pushback do you get to just sort of a more realistic view of the potential risks, given that only the rosiest seem to have come to pass?
Well, look, I mean, our clients are active managers, right? So they're not worried about the S&P 500. They're trying to find what works. I mean, for all of the headlines we get around the S&P 500, I mean, what we usually talk to clients about are individual sectors and stocks and like what's going to work. And so like last year we get an F on S&P, but we get probably an A or B on being in the right places in the market. And that's our job, and that's what active managers are trying to do. So, you don't have to be super bearish, it's not about being bullish or bearish. It's about being bullish in certain parts of the market and opportunity and being cautious or concerned about others. And look, last year was a really great stock picking market. Most stocks, up until October 27th had a tough time. And then we had this little rally at the end of the year. And we've been very consistent about this over the last 12 to 18 months, as you guys know. I mean, we don't think the trade is to then go to the lower quality bucket, okay? To go for the low quality cyclicals, and like that's a recession trade. We're not in a recession. You need a clearing event. That was our call in 2020. Then that worked really, really well. Don't overthink it, right? You need to buy the high quality growth stocks, and it's not all Mag 7. All right, there are other businesses that have those characteristics who are maybe not as appreciated.
It's the Mag 4. It's the Mag 1. Lisa making friends. I love how you did that.
Well,
do you get the feedback that I get? People hating on you for being gloomy?
Oh, yeah, all the time. It's okay. I mean, honestly, I actually don't think I'm all that gloomy, but sometimes.
Not at all, Bramo. Not at all. That brand is so unfair. I agree. Mike Wilson, you're going to stick with us from Morgan Stanley.
So
I'm pleased to say. Equities right now positive by 0.4% on the S&P. You're like the most gloomy person I know on markets. Seriously. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. EU leaders struck a deal to send 50 billion euros in financial aid to Ukraine. The agreement happening after Hungarian Prime Minister Viktor Orban lifted his veto on the package. Under the deal, EU member states agreed to debate the implementation of the aid package every year. The breakthrough avoids a contentious split within the EU and marks a significant win for Ukrainian President Volodymyr Zelensky. At least a dozen major cities around the world are heading for a decline in residential property values this year. Hong Kong is expected to show the steepest drop, with prime residential prices likely to fall more than 10% amid high interest rates and political uncertainty. New York and San Francisco are facing similar headwinds, with both cities impacted by remote work and low return to office rates. Workers in transportation and warehousing took home record pay in the last quarter, according to new data from the Bureau of Labor Statistics. Employment costs in transportation jumped a record 6.3% in the fourth quarter from a year earlier. Meanwhile, factory workers fell behind. Their pay climbed just 3.7%, in the biggest gap between the two sectors on record. That's your Bloomberg Brief. John?
Yahara, thank you. Coming up next on the program, rising concerns facing regional banks and commercial real estate.
I'd say, for the most part, everything's in the rearview mirror now. So yesterday's announcement on NYCB was a bit of a surprise. I think that's an outlier.
Live from New York, that's coming up next. You're watching Bloomberg TV. Live from New York City, equities doing okay, 1 hour and about 14 minutes away from the opening bell, positive here by 1/3%. Yields higher by almost a basis point on a 10-year, 392.17 on a US 10-year this morning. Under surveillance this morning, rising concerns over regional banks and commercial real estate.
I'd say, for the most part, everything's in the rearview mirror now. So there were a few idiosyncratic bank failures that related to the business model and how fast those banks grew, and then the stress caused by the Fed raising rates very quickly. So yesterday's announcement on NYCB was a bit of a surprise. I think that's an outlier.
Here's the latest this morning. New York Community Bank Corp plunging as much as 46% yesterday after the bank's loan loss provision surged to $552 million. The bank took on part of Signature Bank last year during the crisis in regional banking, including a pair of troubled loans for a co-op complex and office space. Herman Chan of Bloomberg Intelligence joins us now for more. Herman, good morning to you.
Hi.
New York Bank community problem, or is it a banking industry problem?
It's more of a New York Community Bank issue. It's indigestion from the Signature acquisition. They cleared the $100 billion in asset threshold, which ushers in higher regulations. They're conducting the stress test with the rest of the larger regionals and the biggest SIFI banks later in this year. So it seems like the whole issue of cutting the dividend, increasing the loan loss reserves is to better put themselves in a place to pass the test.
You know why this spooked investors? It involved commercial real estate.
Correct.
We saw provisions up at a Japanese bank overnight, saw the same thing from Deutsche Bank. We've seen this a few times now, and that's going to get people worried. We're going to see more of it.
Right.
Do you not share that concern?
There is still concern because we haven't really seen the real pickup in commercial real estate defaults yet. That will happen later this year, 25, 26. So it's going to be a long cycle when we see charge-offs really affecting the industry. But overall, the banks have been reserving against the eventuality of higher loan losses.
Mike Wilson of Morgan Stanley is still with us, and I'm wondering, you were talking about how the real issue is credit being constrained. How much of this is all priced in, though, already, given how decimated regional bank stocks have been?
Yeah, well, once again, I'm more focused on the impact on the broader economy. Okay, so you could also say that small caps have underperformed for part of that reason. Okay, but we do have a refunding need over the next 12 to 24 months across the broader economy. Even these are private companies too. So to me, that's the thing to watch. We have C&I loan growth now, which is basically flat on a year-over-year basis. Does that go into negative territory? That would be my main concern. Now, maybe that changes. Maybe these write-offs are going to be the catalyst to get regional banks to say, okay, we've cleared the decks and now we can start lending again. That's a possibility. But this is a live sort of situation that's going to weigh through earnings, and it's another reason why we're just going to be slow in terms of making that move to small cap
Herman,
stocks.
when you analyze some of the underlyings in the balance sheets, do you find that loans are really slowing and that they are having some sort of constraints on how much they can extend?
Yeah, so in the fourth quarter reporting for the regionals, loans were flat across the board. And really that's a function of banks have pulled back a little bit in terms of shoring up their capital in their balance sheet. And second, it's not a lot of loan demand given where interest rates are. So across the board, management teams have talked about less demand from business borrowers because of high rates and less need to invest and being a bit more cautious from their commercial borrowers.
Since the pandemic, Bramo, there's just been this feeling that ultimately we're not going to see the credit stress we would see in a normal cycle because of these massive transfers we saw from the Treasury to individual balance sheets, household balance sheets, super strong. We saw the same thing with corporate balance sheets as well. They termed out all this debt, super low interest rates. Do you think, Mike, that we could get through a cycle without credit stress? And I think that's why we keep going back to commercial real estate, because it's this one part of credit which we can identify as a problem area. Do you think it is the problem area to focus on?
No, I don't. I mean, I think, look, commercial real estate usually is a, kick the can type situation. I mean, we had probably a much bigger CRE problem in the 80s. It took 12 years. I mean, we had two kind of, RTC 1, RTC 2. I mean, so my guess is it's going to be a situation where, once again, it just constrains the ability for the banks that have these loans to lend to other businesses. Now, your other question, I think you laid it out right, which is that there was just so much savings created in the pandemic that has allowed the consumer to avoid the typical kind of credit cycle, and because they termed out their debt. Now that may morph itself. Now, look, the cycle's not over, right? So eventually there will be a credit cycle. Okay, is it this year or is it 3 years from now? That's what we don't know. But we're moving in that direction. In other words, we're past the midpoint, right? Credit situation, credit conditions are tight. They're tight. So that's late cycle, and that's why we think the quality trade is still the right place to be.
You mentioned the banks. Let's just sit there just for one further step. It's going to hinder their ability to finance the economy. Got that. That also means that it's going to be a massive headwind to profitability, surely, for the sector. Would you extrapolate that right out through the whole banking sector, or just for a small group of banks, regional banks, smaller banks?
Oh, no, I mean, the market's been really efficient. And I mean, not just in the banking sector, it's like all over the place, right? I mean, this is why the Mag 7 did so well last year. They were the only companies really showing positive earnings revisions. We have the data. I mean, so I think the market has done a really good job of idiosyncratic risks are being priced. To your question earlier, is it fully priced? Well, it's getting priced, you know what I mean? But stock by stock. It's not systemic. And we're going to see more of these. I don't know which ones, but there's going to be more situations where there's going to be some winners and there's going to be some losers. And I think that continues.
So, Herman, let's put some ideas around the idiosyncrasy, I'll get my words out, of the moment. Sure. We were just talking about $100 billion in assets being the threshold for some new regulation that could force some of these write-downs. How many banks are on the precipice of that $100 billion in asset kind of level?
Right. So there's going to be two new banks that are going through the stress test this year. New York Community, which bought Signature Bank, and First Citizens, which bought SVB. So those are going to be new participants. First Citizens has a much higher capital ratio versus New York Community. So it is in a bit of a better standing heading into the stress test. And then there's a couple banks like Comerica and Zions that are in that 85 to 90 billion range. And what I would say is that they're not really growing their balance sheet at this point in the cycle. And so they have some runway, maybe 2 or 3 years before they pass over. So they've got more time to develop their systems and processes before they undergo the stress test.
Herman, good to see you.
Thank you.
Herman Chan of Bloomberg Intelligence. Got some time for some final words with Mike Wilson and Morgan Stanley. Mike, you mentioned this a little bit earlier in the conversation. Let's build on it. International. It's just felt like that the only game in town has been US tech stocks and Japanese equities. I think someone said that on the programme yesterday. Does anything else take your interest on the international stage?
Well, I mean, Japan is international. Yes, that has been our favorite region for the last couple of years. But a lot of that's currency. So I think the risk on the Japanese trade probably is currency, and that usually does move markets. So if the Fed gets more lenient this year, right, the dollar will probably weaken at some point. The question is which currency is the beneficiary of that? That's going to be a big switch. Usually that's good for EM broadly, and China has its own kind of story. So EM, I think, is going to be idiosyncratic as well, but I do think EM is the place to be when the dollar starts weakening, but we're not there yet.
Where does Europe fit in?
Europe is Europe. I mean, it's just not that exciting. They're kind of hovering around recession. They're not in it. They're not out of it. It's just low growth, unexciting. I mean, if there's things going on around the world, people choose to go somewhere else. I don't see why that changes. I just don't see. I don't see that changing.
I don't take it personally, Bramo. Christine Lagarde might over at the ECB. We'll see.
All I can say is I love that there's the FANG in the United States and there's the granolas.
Europe.
It says everything. Europe, exactly.
Europe's going to Europe, you know.
Europe is Europe, I mean.
Basically.
Hey,
Mike, it's good to see you.
Great to see you
Been
guys.
too long. Great to catch up. Mike Wilson there of Morgan Stanley. Equities right now on the S&P 500, just to run through the price action about 60 minutes out from the opening bell. We are positive by 0.3%, but those gains fade just a little bit this morning, Lisa. The 10-year is back down to about 3.92.
Yeah, when people take a look at the actual statement, basically this is a Fed that's poised to cut. It's a matter of when. And I don't know that it matters all that much for people who are looking with like a 2-year horizon. Maybe if they're looking at a 1-month horizon, it matters a bit more.
We'll get the thoughts of Stephen Stanley on that 1-month call and 2-year call as well. Stephen Stanley of Santander looking ahead to tomorrow's payrolls report and reacting to the Federal Reserve and Chairman Powell news conference yesterday. Live from New York City, this is Bloomberg. Mike McKee has thoughts. He'll share them in a moment. Our next guest, is that what he said? Our next guest doesn't think we'll get rate cuts until after the election. Look out for that in a moment. Equities right now on the S&P 500, positive here. We are positive by 1/3 of 1%, on the Nasdaq up by 0.5%. Waiting for some economic data, jobless claims in focus. The ISM a little bit later this morning. Into the bond market, yields look like this, just about unchanged on a 10-year, down a basis point. Let's call it 390. With your jobs data and a little bit more is Mike McKee. Hey, Mike.
Hey, John. Well, we do have a little bit of a jump higher in jobless claims, which probably doesn't surprise a lot of people given the number of layoff announcements that we've had recently. Jobless claims rise to 224,000 from a revised 215,000. Not a huge jump, still within a range, but a little bit higher. Now, I know one of the people who has drilled into me that you don't pay attention to jobless claims in the holiday seasons is Stephen Stanley. He'll be on in just a moment. See if we've gotten outside of that season yet where we could actually say there's something to this. The other big number out this morning is productivity, the first read of productivity for the fourth quarter, and it comes in at 3.2% after 4.9% in the third quarter. So another big number, another strong productivity number for the U.S. economy, and one of the reasons perhaps that we are seeing inflation come down even as workers are getting more money. Unit labor costs rise 0.5% after falling 1.1% in the third quarter. So decent news this morning, not terrible jobless claims, but at least reflecting maybe a little reality.
We'll get into the price action, Mike. Equity futures still doing okay. Not a big move here at all. We're positive by 0.4%. Into the bond market, yields basically unchanged on the session. 10-year 391. The 2-year yields were a little bit higher this morning. Just for reference point, 420 on a 2-year at the moment. Got a note from Bank of America a moment ago, worth bringing up. Michael Gapin was looking for a March rate cut, pushed that out to June now. June rate cut is the call from B of A. Risk to a later and faster policy easing cycle arising, Lisa. The latest from B of A earlier this morning.
And this really is the key question. Does it matter if the Fed pushes out to a later rate cut if they accelerate some of the cutting cycle? Mike, what was your big takeaway yesterday, and how does the jobs data that we get tomorrow kind of factor into it from the Fed?
I was actually writing up a piece on the jobs numbers tomorrow, and I have to put in there that they aren't going to really matter to the Fed unless they're really outside the parameters of what's expected, because right now they're looking at inflation. They know that the labor market is performing well. As Powell said, this is a good economy. And he suggested they have now abandoned the idea that unemployment has to go up in order to bring inflation down. So less emphasis on the jobs numbers unless they start falling off significantly, because he said then the Fed would have to think of an earlier cut. But beyond that, it's all about inflation now. And I think Powell was pretty specific in saying what we want to see is basically the same news. We want to see the same kind of progress. Doesn't have to be better. But if we get a couple more months where, in general, the PCE rates go down, then we can move. And the advantage to them for May is they get 3 more PCE numbers. So they will have more data. He said 6 months isn't enough. Maybe 9 months is. We'll find out.
Mike, I just want your thoughts on what happened in the banking system yesterday. They removed the reference to banks in the statement. Then we got this tension with one specific bank here in New York. It didn't come up in the news conference. Your thoughts on where the Fed is at with regards to the banks?
I don't think they've changed their view that the banking system is sound and resilient as they had said. I think it was coincidence that was taken out. Most of the statement referring to current situations was rewritten yesterday. The back half is boilerplate. So it wasn't that they are ignoring a situation like that, but New York Community Bank is not a big bank. It has a loss because of real estate. Remember, they took over Signature Bank accounts, so probably that was part of it. And you're going to have losses at banks because of commercial real estate. So it doesn't seem to be a systemic problem in the sense that it's going to spread through the banking system or cause runs in the same way that we saw in March of last year. So I don't think the chairman would have had a lot to say about it because he wouldn't have been informed about it enough to really talk about it.
Mike, appreciate it. Good to see you. As always, great work. Always give you a victory lap after the Federal Reserve. Thank you, sir. Jobless claims then, the final read on the jobs market before payrolls tomorrow. Santander chief economist Stephen Stanley has his eye on labour force participation, writing this: if we cannot count on a repeat performance from the labour force participation rate in 2024, it will be tougher for the unemployment rate to back up further unless or until the economy and the labour market weaken more dramatically. I see the unemployment rate holding in the 3.5 to 4% range. Stephen, I'm pleased to say, joins us now. Stephen, good morning.
Good morning.
I'm not going to bury the lead. I'm going straight to it. You're looking for 50 basis points worth of cuts, not at the next meeting, not in the summer, for the whole year and not until after the election.
Correct.
Why are you all the way out there? Because this is super contrarian. What's driving it?
So I think number one would be that I think the inflation numbers are probably not going to be as good in the first half of this year as they were in the second half of last year. A lot of one-off and temporary factors that were helping to bring inflation down will probably not be repeated in the first half of the year. So, and you kind of got a sense of that yesterday. I mean, to Mike's point, we've had 6 months now of the core PCE deflator running a little below 2%, right? And I'm sure there are a lot of frustrated market participants saying, well, isn't that enough? And the answer is no, because if you look at the distribution of what is driving inflation lower, it's a lot of the noisy categories. So the underlying inflation piece is not as good, I think, as the numbers would suggest.
Let's build on that. Let's get into it. You're right. Chairman Powell talked about it. He was actually pretty transparent about the whole thing. He needed more of the same data, concerned that over the last 6 months, maybe the drop in inflation had been down to what you call one-off factors, worried that things would stabilise above target. What are those one-off factors that help drive inflation lower over the last 6 months that you don't think will be there over the next 6?
Yeah, so a lot of the noisiest categories in the core, airfares, hotel rates, used car prices, and then if you switch over to the PCE deflator, which has a lot of really obscure stuff in it, one of the things I would point to would be financial services costs, which are very hard to measure. It's very debatable, the way that those are measured. But they were down pretty sharply in the second half of the year, and I mean that just doesn't, to me, that doesn't jibe with what we're seeing.
Although, was there anything that you heard from Jay Powell yesterday at the press conference that gave you pause, given the fact that they seem poised to really cut rates as soon as they feel any comfort whatsoever? I mean, if things don't necessarily take a material tick upward in inflation, they're going to be cutting rates.
Yeah, at some point, and he was clear about that. I think he was reflecting that the situation probably hasn't changed a lot from December. We have the dots from December, so we have a sense of where they are, and the median was for 3 cuts, and I only have 2, so a little different there. But yeah, I mean, I actually was encouraged because, given all the market talk about cuts in March or in May or whatever, to me, they don't seem particularly close to being convinced. And he only was willing to go out as far as March, but even, based on what he said yesterday, I would say even a May cut would really require some pretty stellar inflation data over the next few months.
We did just see initial jobless claims climb to the highest levels in a couple of months. Granted, it's probably noisy data, as Mike was pointing out. What levels of job kind of weakness would you have to see before you shifted gears, whether it's tomorrow's data or just down the line?
Yeah, no, that's a really interesting point. And Mike made, I think, the really salient point there, which is a year ago, Powell and the Fed were saying, hey, we're going to have to see a weakening in the economy. We're going to have to see subpar growth. We're going to have to see the labor market cooling to get inflation where we want it. And now they're not saying that anymore. So the jobs data are not necessarily vital in that sense. But if the economy and the labor market do start to weaken in a meaningful way, it would accelerate the thinking at the Fed. So for me, I'm looking at the unemployment rate. Does the unemployment rate back up significantly? We've been in that 3.5% to 4% range that I cited in the piece for about 2 years now, and we're still solidly in that range. I think we'll eventually get above 4% this year, but it's going to come in the back half of the year, not in the first half.
I want to talk about the politics. You don't see these cuts coming until after the election. Is that for good reason? Is that associated with the election itself? What's that about?
So I would say here's where the election plays in. If the market's right and the Fed gets started early in the year, they can just keep going right through the election. And they've done that on either side, tightening or easing in the past. But I don't think they want to make newspaper headlines in the heat of the election season. So if we get through, let's say, the July meeting and they haven't moved yet, then I think the first move is not going to come until after the election.
But for those that are concerned that if he cuts, it looks like a boost to Biden, if he doesn't cut, doesn't it look like he's trying to sink Biden?
They're damned if they do and damned if they don't, right? So I think they have to do the right thing. But I would say, in my view, the political risk is much lower after the election than it is before, because you don't have people campaigning anymore, right? So what they really don't want to have is they don't want to have one candidate or the other who's going out and making speeches every day saying, the Fed is doing this wrong or the Fed is biased or whatever, and you won't have that after the election.
You've clearly got a window in mind. You said July, which makes me think that even if they do start before July, do you think they'll stop in July? What is it about going into the summer that you think is just not going to be the thing that this Fed wants to do?
Well, again, it's really historically they've tried to avoid being in the news during the heat of the election cycle, which is really after the conventions. So kind of into the summer, almost Labor Day to Election Day. But I mean, they're not in the news if they're cutting for the fourth meeting in a row or fifth meeting in a row, right? So if they get started early, they can just plow right through, and they've done that before. But I think the first move is always the biggest, the most significant one, and I don't think we'll see the first one coming in the month or two before the election.
Stephen enjoyed this. It's funny, we're calling it super contrarian, but 50 basis points of cuts is only 25 basis points out from the dot plot.
That's what I keep telling people.
It just feels so foreign because of what the market's priced for, Lisa, this year.
It also is, when do you start? And it sort of raises this question of, are they basically stymied in not being able to move as much if they start too late? You know what I mean? Because of the political calendar. So that's something else. The first cut is always the deepest. I now have that.
Okay, you're going to start singing?
No, I'm not going to sing.
Okay, Stephen, thank you. You should run. Stephen Stanley of Santander. Let's get you some stories elsewhere this morning. Let's get you the Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. The BOE has opened the door to interest rate cuts. The central bank slashed its inflation outlook for 2024 and dropped guidance that borrowing costs may have to rise again. Its Monetary Policy Committee left the key rate unchanged at 5.25%.
If we were to keep bank rate at 5.25% for the next 3 years, we think it's likely that inflation would eventually fall significantly below target. But if we were to follow the market conditioning path, we think inflation will be above target for much of the next 3 years.
The committee was split on action, with 1 vote to cut, 2 to hike, and the remaining 6 members voting to hold. Elon Musk is going all in on Texas, seeking shareholder approval to move Tesla's corporate registration from Delaware to the Lone Star State. Musk took to his social media platform X to poll users on the change before saying Tesla would soon hold a shareholder vote. It came after a Delaware court voided the CEO's $55 billion pay package, calling it excessive. He's already moved Tesla's home office to Austin and relocated himself and his charity to the state. FTX, the now defunct crypto exchange, said it plans to repay former customers and creditors who can prove their losses. A lawyer for FTX said restructuring advisors will examine millions of claims to filter out those that are illegitimate. Attempts to restart the exchange have also been halted after the team overseeing the company failed to find investors willing to inject cash. And that's your Bloomberg Brief. John?
Yahara, thank you. Coming up next on the program, high hopes for big tech.
When you look at Microsoft and Google, the results were fine. It's almost like the market's looking for a bit of a reason to pull back, and that's understandable given the run that they've recently had.
Earnings from Apple, Amazon, Meta coming up after the close, going into the opening bell, about 47 minutes away. Your equity market on the S&P 500 shaping up as follows. Equity futures on the S&P positive by 1/3%. Live from New York City, this is Bloomberg. So here we are going into the opening bell, 45 minutes away. Equity futures on the S&P 500 attempting to bounce but fading a touch. We're positive by 0.4% yesterday. Big one-day rally. Biggest one-day move, or rather one-day sell-off, going back to September on the S&P 500. Biggest one-day move lower on the Nasdaq, going back to October. Pretty dreadful stuff, sparked by Chairman Powell pushing back, throwing some banking stress. Lisa, take your pick. Yields 390.28. Decent rally there, that's for sure.
Yeah, and it's definitely on the heels of jobless claims having just come out at about the highest, the wrong side of a kind of upside surprise in about 2 months. Right now, we're seeing that two-year yield at about the lowest going back to January 15th. So I guess not that much, it's 2 weeks. But still, I'm looking at this and I'm just thinking to myself, okay, how much are we pricing out rate cuts in March? But that just means that they're going to be sort of consolidated in a shorter period
Chairman
of time.
Powell set this up yesterday, and we talked about it earlier this morning. We're comfortable with stronger growth, but if it weakens, if the labour market starts to crack, we have the ability to step in now. And I think that's the change over the last 12 months. They have that room now, that space, that if things weaken, they can move earlier.
And there's a different bias in the market. If we get a jobs report tomorrow that is seriously disappointing, I would guess that the balance of risks is for an even greater rally in the bond market than there would have been before, just simply because the Fed is more cognizant and sort of going to be responding more to weakness than to strength.
Before we get to payrolls, we need to talk about earnings. Under surveillance this morning, high hopes for big tech.
When you look at Microsoft and Google, the results were fine. It's almost like the market's looking for a bit of a reason to pull back, and that's understandable given the run that they've recently had. But we do think this is a gap year for Gen AI. We had the excitement in 2023. We really get the monetization noticeable in 2025. So the big question is, will the market be patient and wait for that to come through?
Here's the latest this morning. Meta, Amazon, Apple reporting after the close following disappointing results from Alphabet and Microsoft. Pierre Ferragu of New Street Research writing this. We recommend staying away from Apple. If comments and guide are cautious on the iPhone, investors will struggle to see a next catalyst. Pierre Ferragu, I'm pleased to say, joins us now for more. Pierre, wonderful to catch up with you, buddy, as always. It's kind of bizarre that we had a name rally by almost 50%, I think up 48% in 2023. And yet we're sitting here today asking this question: can Apple avoid its fifth straight sales decline? What was supporting that run, Pierre, last year before we get into the year ahead?
Yeah, that was a very, the stock behaved in a very surprising way in 2023. So you saw the run mostly at the beginning of the year. It really went with all the tech stocks that recovered. So I don't think that was really specific to Apple, but it reflected just growing optimism on the fact that the outlook for all tech, all what's tech related, all strong players, strong franchises in tech, having been battered down in 2022. And then what you see it well on your charts. Since June, the stock has been trading sideways in a fairly large volatility gap for that name. And that's really what happened. People saw a bit of weakness, but never, compared to what we've seen elsewhere, like in autos with Tesla, in semiconductors at Broad, Apple on a relative basis looked very, very resilient. And that's really what the stock told us over the last 6 months. And that's where we are today.
So how big of a disappointment are you expecting tomorrow? I mean, or later today, I should say. How much are you seeing this play out in this earnings cycle versus just sort of a slow bleed over the next, say, year?
Well, Liz, it's always difficult to time things. We don't have any significant edge in order to call this quarter and to see something coming. What we saw is a lot of weakish, painful data points in December about China, consumer demand being weak, Xiaomi and Huawei being back. Remember that Apple, in 2020, 2021, gained easily 20 million units out of Huawei getting out of the market. And now Huawei is coming back and Xiaomi is doing well. And the Chinese consumer sentiment is what it is. So my concern would be that today expectations reflect a flattish, sort of iPhone kind of development on between 2023 and 2024 and beyond. And so if there is a crack on iPhone expectations, if management feels the need to guide down on iPhone, that's really the quote you took on your screen. It's if that happened, then it's going to be difficult for investors to be patient and wait for the next catalyst. So that's the risk I would see on the stock tonight. Do I have a high conviction that they're going to disappoint? Not really, to be honest. It's more of a risk than a conviction.
Guest after guest come on here and they say, we might see Magnificent 4, Magnificent 1, Magnificent 8 given AMD, but that seems to have fallen by the wayside for the moment. Do you think that Apple doesn't belong in the same category simply because they're not as leveraged to the whole AI kind of trend?
Yeah, I think it's a very important aspect of Apple. Apple today is the highest quality consumer franchise in tech in the world. So that's a great business, a great investment for that reason. But you don't see any news flow or barely see any news flow on AI with Apple. And of course, they're working a lot on it. They're spending $1 billion on it. They're going to come up with something like the iPhone user experience will be probably revolutionized by generative AI. But they're not on the forefront of that. And the news flow on that front might be concerning or very weak at the very least in the near term. So that might make Apple actually, falling a bit off that group.
Pierre, this is something I've always struggled with, and it's a question I often ask you. I come to you with this question. What multiple do you put on this name? You've got the core growth story of the last decade, which is the iPhone going X growth. At the same time, the revenue mix is shifting towards services, and we've seen that over the last year. Pierre, what multiple should you put on this stock?
Well, so it's a very, very high quality franchise, which means that Apple will always be able to grow, in high single digits their earnings power over a long period of time, even if nothing exceptional, nothing magic comes through. So Apple probably is still worth a premium on the S&P, a premium on the overall market, but not a premium for growth, a premium for quality. So the stock is trading on 25 times, what could be a good earning in 2025 today. And I feel like I think it's a reasonable multiple, and which means that between now and well into 2025, maybe the stock doesn't have much room to grow, because if we are on a 7-8% earnings growth trajectory, that's the only kind of upside you can expect if the multiple is already full. But I think the multiple of today is a bit fair. Now, if we come into a period of duress for the iPhone and a pullback in the iPhone, you could see a multiple compression, and that would create more than anything an opportunity maybe to buy a high quality name.
Pierre, I wanted to finish with a multiple question, but on a different company, a company that falls under your coverage. You know where I'm going. I'm going to talk about Tesla. Should I be valuing this now just a traditional car company going against Chinese manufacturers? What is this now?
It's a very good question. Tesla is at a very, very interesting point in time where they're basically maxing out their addressable market today with the portfolios they have today. What's very interesting, we've pulled a lot of numbers together recently with the team, and we've found out that Tesla has actually addressed already 15% of their addressable market today with the Model Y, the Model 3, the Model X, and the Model S. So Tesla has come through a first leg of development very successfully. And now it's a 15% market share player on their addressable market. Just as a reference point, the largest car manufacturer in the world has only 12% of the total market. So that's a very high market share in autos, 15%. And now what can they do? They still can grow. They're still guiding from some growth this year and next. of that portfolio, which means that they are going to continue to gain share or expand their addressable market with trading up. And then in 2 years from now, they will be ramping in very high volume, lower price point cars, the next gen model, the Model 2, that will like quadruple their addressable market in volumes. And they should still be able to achieve 15% market share. So Tesla still has like an exceptional growth opportunity ahead of them. And they are in a transition phase now. I think in 3 to 6 months, they'll start expanding margins again when prices stabilize and costs continue to come down. Excepting the Chinese, they don't really have competitors on their like EV segment.
Yeah.
And if they took 15% of their addressable market with what they have today, they should continue to grow from there. And with the Model 2, that's a very high growth potential.
We'll talk about CEO pay another time. Pierre, I know you've got to go. Pierre Ferragut there of New Street Research. Pierre, thank you. Anticipating Apple earnings just around the corner after about a little bit later. Tesla, it's got to buy, Bramo, 255 price target.
Talking about just the addressable market and how much of it they have. I mean, at a certain point, are you buying an electric car, as you've pointed out, or are you buying a Tesla? And that's sort of been a key question.
We've both been asking that question. I think we all have over the last few months. Coming up tomorrow, it's Payrolls Friday. Don't miss this. This lineup is absolutely stacked. Ellen Zentner of Morgan Stanley, former Fed Governor Randy Kroszner, Jeff Rosenberg of BlackRock, and our good friend Mohammed Al-Erian of Bloomberg Opinion. All of that and more coming up tomorrow from New York City. This was Bloomberg Surveillance.